medium term, it is really hard to make an argument that doesn't favor the U.S.
We need to be conscious of the fact that U.S. markets are trading at a 20% premium.
Retail investors are now a little bit more bearish, institutional investors are a bit more bullish.
If you are a stock index that's exposed to globalization, then there needs to be a higher premium.
From an index standpoint, you may not see as much excitement this year, but at the individual stock level, you could see a lot more excitement.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, transatlantic all-time highs. Your equity market stateside shaping up as follows. Equity futures just a touch softer. We're down by 0.1%. Similar move on the Nasdaq, but over in Europe, once again, the equity benchmark in Frankfurt, Germany, at a brand new record. That stock benchmark is absolutely flying. And in the face of this, President Donald Trump announcing he would impose 25% import tariffs on autos, semis, and pharma.
Listen to what he says, but don't take it seriously, seems to be the market response. And what people are listening to more is the potential for there to be some sort of coalescing of European leaders to get together and take action. There also is a feeling that the dynamism of the U.S. economy will only rebound well upon Europe at a time where people say that you're basically at all-time lows when it comes to optimism. Put this into perspective. This will be the 9th straight week of gains for the stock 600. It is up almost 10% so far this year. Not so shabby, even with 25% tax.
The DAX in Germany has hit another record high. European autos are up almost 8% in the previous 7 days. So are we leaving behind the worst of it or just whistling past the graveyard? I guess that's your call this morning.
Well, we'll have to see also because the Europeans' top trade official will be in Washington this week. Trump yesterday was talking about the fact that he thinks Europe did make a deal when it comes to the autos. It seems like the market at the moment is not stressing out about all the trade threats and warnings he's putting out there, and they are just moving higher. When does the market actually potentially be that check on some of these tariffs? April 2nd, another date in the diary to watch. So we have March 12th, March 4th, and April 2nd for potentially those auto tariffs in the neighborhood of 25%.
So here's a really important one coming up tomorrow. Do not miss this. Coming up tomorrow morning at 7 a.m. Eastern Time, Scott Bessent, the Treasury Secretary, live in the studio for 25 minutes to break down what is a negotiating tactic, what is the objective of trade, and then we can get into Bramo's bond market a little bit more as well.
So when Scott Bessent talks about trade, and this was in his hearing, he talks about 3 pillars: revenue raising, reciprocity, and warnings and tariff threats. And right now what the market is doing is they're having to digest every single sector and country, depending on what they think Trump is after with that tariff threat. Is this reciprocity of trade? Is this going to be revenue raising for the tax cuts? Or is this just a negotiating tool like he did with Colombia?
This, to me, is the key point, and I'm really glad that you brought this up. To me, there are those 3 pillars: reciprocity, negotiating tactic, and then bringing manufacturing back to the United States. And this question of how much you want to reinvest in the United States, it is unclear which is which. It is unclear which is negotiable to be taken off versus a doubling down. And that is the reason why right now this market is not taking it seriously until otherwise told, except for maybe China, which is a different story.
Equity futures this morning down by about 0.1%. We're all looking forward to that conversation tomorrow morning. Later this hour, we'll be catching up with Keith Lerner of Truist as stocks hit a fresh all-time high. Ed Mills of Raymond James as President Trump floats 25% tariffs on autos. And Subadra Rajappa of SocGen as Secretary Bessent pushes spending cuts. We begin this hour with stocks inching just a little bit lower. The S&P 500 hitting a fresh record as traders shrug off tariff risks. Keith Lerner of Truist writing, the primary market uptrend remains intact. We maintain our long-standing US equity bias relative to international markets, given stronger economic and earnings trends. Keith joins us now for more. Keith, welcome to the programme, sir. We started talking about the transatlantic all-time highs. Let's head over to Europe. On the Stock 600 so far this year, the banks are up by more than 18%. Energy over in Europe is up by more than 10. The autos is up by about double digits so far in 2025. Keith, what is going on in Europe? And I'll ask you the question that we were discussing around the table. Are we leaving behind the worst of it or just whistling past the graveyard?
Yeah, well, great to be with you all. So, listen, we've been Team USA for several years, but one thing we noted in the outlook coming this year is that coming into this year, these international markets had the worst relative performance to the U.S. since 1997. A lot of that underperformance happened in the fourth quarter on concerns around Trump. And, the EFI index last year was up less than 5%. And then when we look back to 2016, the playbook we're seeing initially is very similar. Like if you look back after 2016, markets in Europe and overseas bottomed about a month later and had a shorter term rally. So listen, I think it's all about expectations. Expectations were very low, and on a relative basis, you're seeing, the ECB cut rates at a faster pace than here at the U.S., and investors are looking at other places to invest. So I think this trade likely has further to go. I think the fundamental trends longer term are still with the U.S., but it became a bit overcrowded, at least on a short-term basis.
Keith, the big difference, though, between now and 2017, in 2017, the United States and Donald Trump, then the president in his first term, pushed tax cuts first, and then the trade story came about a year or so later. This time, the sequencing has flipped. Do we have to sort of put a little bit more weight on the sequencing here and reconsider what could happen?
No, it's an excellent point. And after the election, we said that the market was initially focusing on the good things or perceived good things of the Trump presidency, and that we'd have to deal with the terrorists and other factors into this year. So I think that sequencing is important. I do think knowing that tax extension is out there and that deregulation is out there, I think is a market support. And I think also zooming out, I mean, if we look at the last 10, 15 years or so, I mean, this market has been battle tested, right? I mean, it's gone through a once-in-a-generation pandemic, the highest inflation in decades, and the fastest rate hiking cycle by the Fed since the 1980s. And what has the economy done? It's been resilient. Corporate profits have moved up, and we're seeing that corporate profits in their first quarter here up double digits. So I think part of the resilience we're seeing in these overall markets is some of these other factors. Also, the fatigue of all the concerns, or what we call the carousel of concerns the last couple of years, where the market has been able to move past it.
Keith, another way of saying this is the market just benumbed to some of the headlines that we've been getting that could potentially have real ramifications? And going back to John's initial point, is this market truly pricing in the idea of 25% blanket tariffs on things like autos and drugs and chips? Or is this market looking past it and saying, probably a negotiating tool?
I mean, at this point, I think it's the latter, right? That the market is basically making an assumption, right or wrong. Everyone's guessing right now that these tariffs will not go into play, or if they go into play, they won't be long lasting. And they're looking at Mexico and Canada as a playbook. And when you look at Canada and Mexico and China since these announcements, all they've been doing is moving up. So I do think, our main thesis this year is a bull in a China shop. I do think there's going to be some disruptions along the way. The market is not factoring a lot of negative news. So I do think that sets us up for some potential disappointment, next month. But I mean, we have time between now and then. And also market indicators like the 10-year Treasury, pretty benign. Oil prices, pretty benign. And employment still pretty steady along with earnings. So I think the market's overlooking some of these things. But I do believe later this year we are going to see some disruptions along the way. But again, we're sticking with that primary uptrend that is still in place, as of now.
But Keith, as a base case, what do you view as tariffs that could be revenue raisers, to Jonathan's point, to make sure they can get those tax cuts through?
Yeah, listen, I think there's going to be a lot of gamesmanship on that. And I don't know what the number is. I think this, going towards the reciprocal side, we had just had this discussion in our strategy meeting yesterday, in that it's pretty complicated. The logistics are pretty complicated. So we would not be surprised if we actually do move towards some type of, more flat tariff rate, but it's likely not to be 25%, and there's likely to be some negotiation. But again, I know the only thing, the market we're talking about is these tariffs, but I don't want to lose sight that the economy is still in expansion. Corporate earnings have adjusted and they're moving higher. And the 10-year Treasury, which looks at all of this stuff, is still relatively stable. And I think those are the key factors that are maybe overriding some of the tariff talks that we're talking today.
All right, let's talk about the economy and where it is, Keith, at a time when you have seen inflation, core PCE, that metric that the Fed looks at, above that 2% target for the longest stretch going back to the 1990s. At what point does this market start to take note of that inflationary impulse at a time where you do have a bull in a China shop, you do have a lot of potential structural changes, and there are areas of the economy that are responding, particularly in the smaller company space?
Yeah, no doubt. And I think there's actually this tension, right? On one side, the potential of tariffs may have that one-time hit to inflation. On the other side, the animal spirits, we really haven't heard that term as much recently because, there's a lot of uncertainty for businesses as far as spending. And that the tension is the one-time inflation hit versus maybe a little bit of a slower economy offset, because companies are likely going to hold out till they have more clarity. Now, The good news is if they do get more clarity later in the year, more clarity on the tax extensions, more clarity on the deregulation, you could actually see a pop later on. In the interim, it will likely lead to a little bit of softer data, and we have that kind of ongoing tension that we expect to continue.
Keith, one thing that we've seen so far this year is the opposite of what a lot of people thought last year, which is a weaker dollar, not a stronger one. Do you think that that's going to reverse? Does that have to reverse for you to remain overweight U.S. equities?
Well, historically, there has been a strong correlation between a rise in dollar and U.S. outperformance. So if you are in the belief that the U.S. dollar has topped and is going to be weaker, then you'd want to invest more heavily overseas. I think our view is more that the fundamental trends are still strong in the U.S., that it's likely going to be more somewhat range-bound. And I think sometimes we talk about whether it's U.S. or international, the S&P market cap or the equal weight. And really what we're seeing today is you're having a global rally and you're having a much more balanced rally. So it doesn't have to be either or. I think within the S&P, all of the sectors are up this year, and 75% of global markets are in uptrend. So listen, I think maybe from where you would have been a few years ago, where everyone was just Team USA, I think the global opportunity set is certainly wider. And I think that's the same thing within the U.S. as well.
Hey, Keith, got to leave it there. Keith Lerner there of Truist. Price is certainly reshaping narrative very quickly when it comes to Europe. You've got to respect a market that stops responding to negative headlines. That would be the headline, I think, with Europe concerned in mind. But I would say there's a more nuanced story at play as well that makes a lot of sense. Let's take two stocks, two defence names. One's Lockheed Martin, the other's Rheinmetall. Lockheed Martin so far year to date, big US defence player, is down by double digits, down by about 12%. Rheinmetall over in Germany is up by more than 50%. I think that speaks to a big realignment that we could be seeing further down the road.
That realignment comes from the U.S. cutting costs, including at the potential Defense Department. That announcement is coming, I believe, ongoing right now, at the same time that you have a recommitment in Europe to invest in defense. It shows why people are following the fiscal, which has more promise right now, at least in Europe.
Armin Papperger, the CEO of Rheinmetall, was on this program a month ago and said Trump is good for Europe because he's forcing the hands of the European leaders to spend more on defense. And that you can see directly correlating to his stock price.
Certainly good for his stock. That name is up by 53% so far year to date, and it's only February 19th. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump said that he will likely impose tariffs of 25% on automobile, semiconductor, and pharma imports. An official announcement is expected as soon as April 2nd. Trump said that he wants to give companies time to come in before announcing new import taxes and said when they have their plant or factory here, there is no tariff. The U.S. Senate confirmed the billionaire Cantor Fitzgerald CEO Howard Lutnick as Trump's Commerce Secretary. He was approved by a vote of 51 to 45. Lutnick will now lead the administration's tariff and trade agenda. Cantor Fitzgerald said 3 company deputies and Lutnick's 2 eldest sons, both in their 20s, will run the business in his absence. The Vatican says that Pope Francis is being treated for double pneumonia after scans revealed the condition in both lungs. The 88-year-old has been in hospital in Rome since last Friday. Church officials now describe his medical situation as a complex picture. The Vatican has asked for prayers for the Roman Catholic spiritual leader who's been at the head of the church since 2013. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. More from Danny in about 30 minutes' time. Up next on the programme, Trump's trade escalation.
Have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%.
April is going to be a big month. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. Record highs at the close in yesterday's session this morning, pulling back by about 0.1% on the S&P 500. In the bond market, yields just a touch higher, up by a single basis point. The 10-year, 456.40. And a surveillance this morning, Trump's trade escalation.
Some of the biggest companies in the world, and because of what we're doing economically and through tariffs and taxes and incentives, they want to come back into the United States.
Have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%. We want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariffs. So we want to give them a little bit of a chance.
So here's the latest this morning. President Trump announcing he'll likely put a 25% tariff on autos, chips and pharmaceuticals as soon as April. Joining us now from Miami, where the president will be a little bit later, Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the latest here and just how long is the list of threats going into April?
Well, John, it's pretty long, right? You heard him there point out this April 2nd date. Notably, that is one day after Commerce and USTR are expected to release their country-by-country studies when it comes to reciprocal tariffs. And President Trump there said that he picked these dates down the road so that he could give our trading partners, quote, a little bit of a chance to move their manufacturing stateside. This really was one of the first times that we've heard a more concrete policy benchmark that President Trump is looking for beyond from what he spoke about on the campaign trail and just asking for our trading partners to start to lower their tariff barrier. So something to look for if we do see an increase in moving to domestic manufacturing. And trade and investment in the U.S. is going to be a big focus for the White House today. I'm here in Miami at the Future Investment Initiative, a Saudi-backed investment conference where President Trump is slated to take the stage tonight at 5 p.m. Eastern. We know, for example, that he's asked Saudi Arabia to invest more than $1 trillion over the next 4 years in the U.S. Experts tell us that that is highly unlikely. However, it has helped to reel in some of the biggest U.S. business leaders here to Miami that could see a benefit from an increased flow of capital between the two countries.
Hey, Tyler, appreciate it. We'll touch base with you a little bit later on that event. Bloomberg's Tyler Kendall. Saudi Arabia at the epicenter of everything at the moment.
I think Trump really sees them as this place they can do business with, whether it's AI investment or it's potentially hosting a summit between him and the Russian president. This is a country he's willing to work with.
To extend the conversation now, Ed Mills joins us for Raymond James. Ed, good morning to you, sir. It's good to see you once again. Let's get back to those tariffs. 25% tariff on autos, chips and pharmaceuticals, maybe as soon as early April. Ed, are you taking the president seriously and literally?
Yeah, I mean, I think what we'd say here is it's unlikely to be 25% off the bat. What we've seen with Canada, Mexico, and China, that whatever the market is focused on, that's probably is not what's going to be implemented. Is there something? Is it a 10% on semiconductors? Nothing that goes on pharmaceuticals in a study on autos? That would be probably my base case here, John. He likes to throw out really large numbers, something that forces trading partners to react and ultimately resets the bar. So if he comes in lower on any one of those threes or exclude any one of those threes, the market will take it as a win and he'll get the victory as well.
We also have the European Union's top trade official in Washington this week. Trump once again said there seems to be a deal on the table when it comes to Europe and their auto tariffs. Do you see this going for like, tariff for tariff between Brussels and Washington?
So I would expand kind of the European auto conversation beyond just tariffs. I think when I have had conversations with the experts in D.C. related to Europe, they say one of the big things about Europe is choosing a side. Is it going to be partnerships with the United States or partnerships with China? And so with the auto space, more joint ventures with U.S. car makers rather than joint ventures with Chinese car makers. Donald Trump sees the German kind of car makers having deals with the Chinese car makers as a national security concern of epic proportions. So part of that deal, in my mind, would be a recentering towards partnerships with the United States, investment in the United States. That's what gets him to back off the car tariffs on European counterparts.
It felt like when Trump was speaking yesterday, it was a bit loosey-goosey. In the neighborhood of 25%, probably April 2nd. So I have a list. March 4th, the pause on Canada and Mexico. That deadline is up. March 12th, the imports of aluminum and steel getting 25% hit. And then April 2nd, these auto tariffs. How much does Trump need to potentially punt so he can align the tariffs with the tax cuts that he's hoping his Congress can get in place?
Yeah, Annmarie, what I hear there is we're going to have weekly, if not daily at times, announcements on tariffs. He's going to keep us guessing, keep us informed. And part of this is a two-pronged attack as well. Number one, move the goalpost, force policy changes that he wants. And once he gets those achievements, he will celebrate that. Prong number two, by moving these dollar amounts in the percentages so high, if we don't get 25%, say we're at 5 or 10%, that is the foundation for a universal tariff that he actually wants. And he will say he's using that money to give Republicans the opportunity to pass tax cuts, do additional spending on key priorities. And so he is doing a both and strategy as it relates to what he's doing here, because he's moving the goalposts, resetting expectations, and going to get some policy wins out of it. And he will celebrate it in each step of the way.
So it sounds like he's in full-on negotiating mode. Then what will act as the revenue raisers?
Well, I think the ultimate revenue raiser is going to be that smaller than expected, but more permanent tariff that goes into effect. When we look back to the Canada, Mexico, China experiment, we were all focused on that 25%, but what was actually implemented was 10%, which looked like a better deal vis-a-vis everyone else. But that being set as a baseline for everything that's coming from China, I think is the base case as we set a baseline for the rest of the world. If he just said that outright, we'd all be freaked out. But if we start at 25%, he says he's going to go higher, but only settles at 10%, Annmarie, or maybe even less if he settles for 5%. That is the political cover for additional spending on Capitol Hill.
Ed, from your conversations with people in Washington, D.C. who cover trade, is there any consistent methodology to how these tariffs are being threatened or discussed, or is it basically just a flood the zone approach?
Lisa, it is a flood the zone approach. I've had very senior conversations with folks in the administration, and they've said a lot of this is do something so big and so bold that forces a policy response. And so last week when we got the reaction on reciprocal tariffs, the fact that we're including the value-added tax, currency manipulation, any regulation or anything that they want to include here shows me just how much they're going to use the force of the United States government, the military of the United States, the economy of the United States to threaten something so large that other countries have no choice but to respond in a way that Donald Trump wants you to respond. But then also having the ability to come in after that and lay down a universal tariff, it is kind of very interesting to watch. And I think it is kind of very transparent of exactly what they're trying to do here, Lisa.
That's on an international level. On a domestic level, is there any methodology that you can glean from some of the cuts that are being made more broadly across the government stemming from the DOGE effort that have been heralded by a lot of people?
Yeah, so on DOGE, you kind of the greater the cuts are, the more fanfare that those come, that's also providing political cover on the budget reconciliation bill. Because the more, if you are going to spend $4.5 trillion plus on extending out the 2017 tax cuts, if you want to spend an additional $300 billion on the military, on immigration, on energy, which is exactly what the Republicans want to do, they need something really big out there, like DOGE, like tariffs, to give them the political cover to say it is okay for us to do this because we are getting savings elsewhere. Again, resetting the bar, resetting the conversation. So what ultimately gets done seems like a compromise, where in normal DC terms, that would be the main fight.
Ed, appreciate the frame, and thank you, sir. Ed Mills there of Raymond James. 4 years ago, an additional 10% tariff on China would have been big news. We've said this before, intended or otherwise, this is masterful expectations management. 25% tariff on autos, chips and pharma, steel and aluminum, Mexico and Canada, more to come for autos, more to come on China, who knows? But the fact is, we got 10% on China and people have barely blinked.
And part of that is because there's bipartisan agreement that there should be some greater distance between China and the U.S. Unclear about how that translates to Canada and Mexico.
Trump comes in with a maximalist approach, moves the goalpost, and that means he is, as Ed Mills says, in full-on negotiating mode.
And keeps moving those goalposts. Coming up on this program, Andrew Bishop of Signum Global Advisors on President Donald Trump's push to end the war in Ukraine. From New York, this is Bloomberg. A small advance to kick off the trading week. All-time highs for the second time so far in 2025 on the S&P 500. Equity futures this morning pulling back just a touch. We're down 0.1% on both the S&P and the Nasdaq 100. In the bond market, Switch up the board. Things get a little bit more interesting later on the afternoon when we get some Fed minutes. Yields higher by a single basis point at a 10-year, 456.59. President Mary Daly saying yesterday, at this point, policy needs to remain restrictive until, from my vantage point, until I see that we are really continuing to make progress on inflation.
This has been the more hawkish tone from a number of members. Fed Chair, San Francisco Fed President Mary Daly is not a voting member. Also, Dallas Fed President Lori Logan, also a non-voter, saying that getting back down to 2% is non-negotiable. A real question, then, of what the meaning of how long inflation has remained above their 2% target reflects upon how flexible they'll be in the x-axis of reaching that.
BMO's Ian Lingen says this bond market is cheapening. It is not cheap. Goes on to say, our take is that the verdict will be out on the inflation front for the first half of the year. It's going to feel like a long time.
I think that every week feels like a long time. I think every day feels like a long time. You have President Trump talking about how this is still Biden's inflation. You have people talking about tariffs. Real question is going to be from immigration, and a real question is going to be from capital investment at a time when people are saying the animal spirits have returned.
Start the second quarter, early April. How many tariffs are we actually going to get?
Yeah,
that list is getting longer.
And to what end? And I think that this goes back to the ultimate question. Are these a negotiating tool? Are these to structurally domesticize production? Because that will actually have more of an inflationary effect. Or is this going to be simply something to raise revenue? And that will make a big difference in terms of how inflationary this is.
Let's turn to foreign exchange just briefly. The euro shaping up as follows. Tons of strength to start the year. I use the word tons loosely, but you get the picture. The dollar's a bit weaker, euro's a bit stronger. Relative to expectations, 104.28. We're negative on the session by 0.2%. Are we leaving behind the worst of it or whistling past the graveyard? The ECB's Fabio Panetta saying after 2 quarters of no growth in the Eurozone and tensions in the manufacturing sector, employment is giving signs of weakening. He's making a case that things aren't getting better, things are getting worse.
Which raises a question about the ECB response function. We've talked about this. They say it's important to still be restrictive at a time where inflation is still a concern. At what point is there some consensus in Europe? Wait a second. Maybe the ECB needs to cut to become less restrictive, and even accommodative at a time where even Germany over the 0% debt levels is talking about raising money to invest in their country.
Euro dollar 104.28. On our radar this morning, President Donald Trump floating 25% tariffs on auto, chips and pharmaceutical imports. Trump saying he will likely formally announce the new levies as soon as April 2nd.
And what happens on April 1st? We're going to get the report from whether it's Howard Lutnick or Jamieson Greer, the Commerce Secretary, USTR ambassador, on what they actually think should be done when it comes to these tariffs. But this is just another addition to the long list that we have waiting in the wings on these potential tariffs. But if Trump is in negotiating mode, potentially, as Ed Mills says, it might not be 25%. It could be 10%. It could be 5%. But April 2, another one for the diary.
All I know is that the market right now is sort of looking past this. You say whistling past the graveyard. Let's put into perspective. Commerce Secretary Howard Lutnick got confirmed last night to take the role that is going to be instrumental in negotiating some of these tariffs. In order to get some of the effects that President Trump wants, there is some time that needs to pass. So people are saying, let's not overreact.
That work already started. I'd suggest already started a long time ago. President Trump alluded to this, that he wanted to do some of this back in 2020. Then the pandemic hit and he felt like being kind, so didn't punish the Europeans. They've been intending to do this for quite a while.
Right, and Peter Navarro, who is probably the most hawkish, I would say, when it comes to trade, is already out there working. I saw him when I was at the White House, out there on Pebble Beach. He is the one that is going to be in all the meetings right now because he's not going through Senate confirmation. A lot of people I've spoken to said, look at the language Trump's puts out in these EOs. They're almost copied and paste from what happened in 2016 when it comes to China. And a lot of that right at this moment is being led by Peter Navarro. So what I see is a big fight taking place April on, because then you're going to have the entire cast and team of rivals in place.
We can talk to Secretary Besson all about this tomorrow morning. Look out for that, 7 a.m. Eastern Time, in the studio for 25 minutes on Bloomberg Surveillance. Let's turn to this story. President Trump and Elon Musk defending the Doge-led overhaul of federal spending cuts. Trump saying he thinks Musk's team can slash at least $1 trillion from the federal budget.
And talking about the $55 billion already saved, of course, a couple of those line items have been thrown into question, and whether it is actually that much remains to be seen. I want to understand what the overarching idea behind this is. Is it simply to cut the people you can, the probationary workers who have just arrived at the organizations? Is it to just cut wholesale departments? Which departments are they cutting, and how much are they actually studying what the ramifications are when some of these departments have pretty instrumental roles in specific and esoteric functions of the government?
I'm hoping, so we're only a month in, I'm hoping by 100 days of Trump, we have actual documentation on what was cut and what was saved. Because the New York Times front page today talks about the fact that they're putting so many savings into an $8 billion line item when actually it was just $8 million. But Ed Mills made a great point in the last segment, and that was whether it's DOGE, whether it's tariffs, all of this is political cover on Capitol Hill for Republicans to go deep in those tax cuts.
I smile every time someone reminds me it's only been a month. They're moving so quickly. It's just been absolutely stunning. Let's round out some of our top stories with this. President Trump also saying he will likely meet with Russian President Vladimir Putin before the end of the month to discuss an end to the war in Ukraine, telling reporters, quote, Russia wants to do something. Trump adding he was disappointed to hear Ukrainian officials complain about being left out of talks. Andrew Bishop of Signum Global Advisors writing a Putin-Trump meeting will likely not take place next week, as had previously been floated. It is a reminder that the pace of talks will likely continue to be slower than US President Donald Trump has insisted they will. Andrew joins us now for more. Andrew, welcome to the programme, sir. I want to pick up on some of the comments that President Trump issued yesterday about Zelensky. It feels like Zelensky's being left out in the cold. The president suggested yesterday that he helped cause this war. Andrew, how are those two individuals going to work together, if at all?
They're not. And for background, Signum's base case on this war has been that there will be no quick ceasefire, no quick peace deal. But the reason for that is not because we expected Trump to be friendly with Zelensky or supportive of Ukraine. The reason for that is that we think that once President Trump starts realizing that this war is intractable and that neither Zelensky nor Putin really want a short-term peace deal, he will essentially just walk away. I mean, Trump had two goals going into this. One was international recognition, the famous, sort of Nobel Peace Prize aspiration. That's not going to happen, and he's going to realize that very quickly. The other goal he had was to deliver to his voters a promise to get out of the war in Ukraine. And here's the kicker. He can get out of the war in Ukraine without actually forcing Ukraine into a bad deal.
Andrew, what kind of timeline do you see set up for this? Jonathan was just talking about we're a month into this administration. They've been very aggressive. And Trump yesterday talked about he would, quote, probably see Putin by the end of the month, the next week. I think a lot of people think that's not realistic. So what does the timeline look like for potentially a summit and then a ceasefire?
Yeah, so for background, the reason that they've been floating next week was because on February 27th, it was expected that Trump would be in the region, in part related to Gaza and the Arab government plan on reconstruction. And they also wanted to avoid Ramadan or have the meeting be held before Ramadan. Those two goals seem to be out of the window now. Our view at Signum has always been phone call in February, meeting in March, talks start in April. That remains our view. And I think if you follow that timeline, essentially the talks will start sort of running aground or looking like they're going nowhere by late spring, early summer, at which stage Trump has to make a decision. Force Ukraine into the bad deal that it doesn't want, which we don't think is likely, in part because of his U.S. constituencies, Republican senators being supportive of Ukraine, et cetera. Force Putin to cave through big oil sanctions, which we don't think Trump will take or go down that route because of the risk of high gasoline prices in the U.S., or just walk away. And our base case is he'll just walk away.
When it comes to Zelensky, Putin, and Trump, is there anything on the negotiating table that all three can agree on?
Yes, actually, they can agree on most of the issues. So, I don't want to use Ukraine, the phrase Ukraine would be fine with this because it would be massive concessions and very painful. But essentially, everyone understands that Ukraine is going to, as part of any deal, is going to have to forego the 5 territories it lost, at least de facto, pull out of Kursk and agree to become neutral, no NATO, et cetera. The poison pill is only one item, which is security guarantees. And here's where we see no overlap between the Ukrainian position and the Russian position, i.e. the minimal security guarantees that Ukraine would accept are probably still too much for Putin to stomach.
When it comes to this potential mineral deal that the U.S. can strike on a bipartisan basis with Ukraine, we're going to have the Treasury Secretary Scott Bessent in the studio tomorrow. He went to Kyiv to present it. Zelensky didn't want to sign this deal. Do you think that there is potential for a security agreement via raw minerals between Washington and Kyiv?
I think there is, but only for the continuation of the war, not for the post-war period. So allow me to explain very briefly. I think the reason that the deal wasn't signed as quickly as the U.S. expected is because it had not been clearly defined what this deal was about. Was it about paying back the U.S. for previously delivered weapons? In which case, the U.S. just doesn't have leverage, right? I mean, it's given the money. There's no reason why Zelensky would agree to pay back post hoc. Was it about paying for continued delivery of U.S. weapons, which we think is essentially what it'll end up being? Or is it about sort of making sure that the U.S. has a vested interest in Ukraine's future the way it does Taiwan, and that acts as a security guarantee? And that, I think, is not realistic because these minerals and U.S. companies are not present in these mineral areas. And Ukraine is just not going to take this pie-in-the-sky promise of security guarantees.
Andrew, could we wrap things up by talking about Europe? We're seeing some real divergence between defence stocks in the United States and defence stocks over in Europe. European defence stocks are ripping to start the year, and US defence stocks are selling off. The market is beginning to understand, I think, this idea that maybe the US pulls back on defence spending, possibly, and Europe's going to be able to boost it. Andrew, do you see it playing out that easily?
I don't, for a couple of reasons. One is I think the U.S. will, and therefore U.S. defense companies will continue to support Ukraine. Again, Trump can walk away in the sense of not having to foot the bill, not being in charge of the deliveries, but still allow the Europeans to buy American weapons, which I think he will. And conversely, we do think that the European defense sector is going to keep going up, and defense stocks have support, but probably not as fast as people expect. And this is one of the reasons why we're taking clients today to Poland and Ukraine as part of a Signum delegation to explore these questions.
Andrew, appreciate it. Look forward to getting a recap once that trip is complete. Andrew Bishop there of Signum Global Advisors on the latest. That's where the thinking is in European markets right now.
That right now you can invest in defense, and that's going to be a real bright spot because there is this coalescing around even borrowing money in order to support that. How far are they actually willing to do this? Because we see all these meetings with Europeans, and they never come to any agreement, and some of them don't even show up. So there's always this challenge of, it sounds good, but then it is Europe.
It's reflexive for the Europeans. There's a crisis immediately. Extraordinary summit, last-minute summit. It has to be an urgent summit.
Always the way.
And then not much comes from it besides a long list of grievances and things they want to do, but they have to have another meeting for it. It's very much they get stuck in the process. One thing Andrew said there that was interesting, Trump, of course, is also not going to say you can't buy more American-made weaponry. So that is something also the Europeans can maybe use as a levy to their advantage.
I say this with the greatest of respect for the man, and truly anyone that knows me knows how much I respect Mario Draghi. Mario Draghi looks utterly depressed and fed up with the Europeans and European officials, and I think that tells you everything you need to know about where they are in doing the kind of things that would be good for them. And I'm not talking about foreign policy, I'm talking about the European economy.
Well, when Mario Draghi piles on to what J.D. Vance says rather than dispute it like the rest of European leaders, you know where he is at in terms of his patience with the region.
That's one to watch. A long, long list of many things to watch going into March and beyond. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A federal judge has denied a request to temporarily bar Elon Musk and his Doge team from accessing internal systems and removing employees at U.S. agencies. Democratic state attorneys general had contended that Musk is exercising power that's supposed to be reserved only for high-level Senate-confirmed officials. Elsewhere, HSBC reported a fourth quarter pre-tax profit that beat analyst estimates. It also said it will incur $1.8 billion in costs over the next 2 years as it embarks on a global restructuring program. HSBC shares are flat this morning, but they have surged about 40% over the past year. Bloomberg has learned that BP is weighing a potential sale of its lubricants business. The oil majors unit, which operates under the Castrol brand, could be worth about $10 billion. A sale of the business is one of the many options BP is considering to win back investor confidence, and as activist investor Elliott Investment Management pressures the company. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Some wonderful one-liners on Wall Street. Here's one of my favorites. You can start buying when policymakers start panicking. Are Europeans panicking? Is that where we are?
It's unclear whether the ECB policymakers are panicking, and that's when people want to start buying. The others, panic has to be when everybody actually shows up.
I got an FT article sent to me this morning by a European when I woke up, and it was, we are in deep explicitive from the Belgium defense minister. So, yeah, they're panicking.
It feels that way. Up next on the programme, government efficiency in action.
I think I saw an estimate today of about 50 billion. So that's a very good start. For the first time in my lifetime, we're going to see a proper accounting. And as the leading bond salesman for the United States, I got a pretty good story to tell.
That conversation up next with Subadra Rajappa of SocGen from New York City. Good morning. Coming up tomorrow, the head of sales for US Treasury. I love that line. It's Scott Besson's line. The leading bond salesman of the United States. What a line. Secretary Besson joining us tomorrow morning, 7 a.m. Eastern Time, 25 minutes in the studio here in New York City. I think we're all looking forward to this one.
Oh, absolutely. That was a great line. He says he has a good story to sell, and he loves that when he's the leading bond salesman. I know Lisa's going to want to ask him why he threw a lot of shade at the former Treasury Secretary Janet Yellen about not selling on the long end in this in bond issuance. And he's come in and he's doing almost exactly what she did.
Well, I want to find out, what his range is, what his technical parameters are, particularly when he says when he sells 10-year debt, and what the margin of error is for him to up the sales on that side.
You think he's got a yield target?
I think that he probably does, actually, or probably a range, because that's essentially the guiding light at this point when he says that short-term rates are not it.
Secretary Besson tomorrow morning, 7 a.m. Eastern Time. Under surveillance this morning, government efficiency in action.
I think I saw an estimate today of about 50 billion. So that's a very good start. And I don't think it's unreasonable to think that we could have several percent of GDP that we are saving. For the first time in my lifetime, we're going to see a proper accounting. And as the leading bond salesman for the United States, I got a pretty good story to tell.
So here's the latest this morning. Treasury Secretary Scott Besson hailing the success of Doge as traders bet on the administration's push to lower bond yields. Subadra Rajappa of SocGen writing, the administration's focus on the 10-year yield and lowering borrowing costs should cap the rise in yields. They can reduce deficits, which they seem committed to doing through Doge. Subadra joins us now for more. Subadra, good morning.
Good morning.
Is this just vibes or is this the real deal?
We'll find out over time, because so far what we've heard from Besson is that they've had Elon Musk and his team have found 50 billion in deficit savings from all of the work that they've put into it. But that's far from the 2 trillion that they're targeting in cutting spending from the federal government. So they have a long way to go to get to that target. So it'll be really interesting to see what they do, how they approach the savings on cuts in spending, as well as ways to change the way they issue, so that they have control over where yields are, so that borrowing costs in general remain quite low for the investors.
There's an idea that's embedded in what you're saying, which is that the idea of the deficit in the United States has been driving the backup in yields that we saw at the end of last year. And what we've seen with the rally this year is an acceptance that maybe that deficit won't be as steep as people previously believed. Is that true? Is that sort of the base case of what's kind of being baked into this Treasury market?
So I'd say that 10-year Treasury yields are kind of stuck between a rock and a hard place. On the one hand, you have inflationary data that's pushing yields higher. You have a global environment where deficits, not just in the U.S. but globally, are expected to rise. I mean, Germany and all the other countries in Europe have to spend a lot more on defense. That's going to push their yields higher. So global bond yields should be moving higher. But on the other hand, you have this commitment almost from Treasury Secretary Besson, as well as from President Trump, that they're going to try to keep a lid on 10-year Treasury yields specifically. So that kind of keeps 10-year yields around that 4.5% level. So it's kind of this very interesting back and forth that you see in the bond market, where you see it rise towards 4.75.
How are they going to cap those yields? Is it going to be simply with the deficit, or is it going to be not selling 10-year treasuries? What's sort of the mechanism other than we care about that? Don't let those yields go higher.
So it's going to have to be a combination of things. One, they're going to have to try to rein in deficits. They're going to have to rein in spending. So maybe that's something that puts a lid on higher on 10-year Treasury yields, because a lot of the rise in Treasury yields has been because of higher term premia. So if there's less Treasury debt issuance, then that should cap the rise in Treasury yields. But there are also other mechanisms in which they can kind of cap the rise in yields. One is they're committed to producing more energy. Maybe that reduces headline inflation, so inflation expectations could come under pressure. That's another way that they're thinking about putting a lid on how high yields are going to move.
Do they edit the issuance?
That's very interesting. We'll have to see how that actually works out, because as you guys were discussing, Bessent, before he became the Treasury Secretary, was actually, calling Yellen's issuance as a sort of activist Treasury issuance. So the question is whether they stick to the same type of plan where they issue a lot more in Treasury bills and not so much in coupon issuance. At least the initial indication seems to be that that's really where they're headed. And that's what the market was really focused on in the last refunding meeting, is that no change, I should say, in the forward guidance, which leads us to believe that they might keep coupon issuance sizes in the long and unchanged for the remainder of the year.
Rubini and Miran put out that paper at the end of last year. Miran's now in the administration and still no change. Maybe we'll get a change, I don't know. I want to understand when you think we start thinking about taxes a little bit more and a little bit less about tariffs and Doge. When does taxes really start to hit this market?
So the tax cuts, I think that they're going to try to pass first. I mean, whether it's one reconciliation bill or two is yet to be seen. That's going to, just the extension of the TCJA alone is going to add roughly $4 trillion increase in deficits. So they're going to have to find ways to offset those increases in deficits with spending cuts. And that's really where I think you're going to see a lot of pushback. Even among the Republicans in Congress, I think you're going to see pushbacks to spending cuts, because it's going to hit their own district, and they're going to try to have to think hard before they agree to the tax deal.
If you ask Secretary Bessent his #1 priority for this year, he will say extending TCJA. We've heard that from him. We've had a whole conversation about the bond market and not talked about the Fed. Are the Fed minutes worth looking at later on this afternoon?
Absolutely, because they will maybe, actually, let me dial that back. They might be, because people are hoping that perhaps they'll shed some light on how the new policies and the policy uncertainty is factoring into Fed officials' views on inflation, et cetera. I say maybe not, because
you're taking it back.
Maybe
just
they won't
yourself.
say anything, and they'll just say, we have to wait and see, and it won't be more clarity.
Should Lisa reschedule that nap?
Yes, she should, because I think that you could get some nuggets of information on what they're thinking about, how long they want to stay on pause.
I said that.
As well as on QT.
Yeah.
And then
any changes to QT?
Well, there is a possibility that it's also going to be pretty opaque and not say anything. Yeah. But, I'm not going to nap. I'm going to be there. I'm going to be reading it.
Special coverage from Bramo. Tune in later on this afternoon on Bloomberg TV. Subadra, appreciate it.
Thank you.
It's good to see you. Thank you. Subadra Rajappa there of SocGen. Up next on the programme, we'll catch up with Alicia Levine of BNY Wealth, Jennifer Flitton of Invesco, Norman Roule of CSIS, and the former NEC Deputy Director Everett Eissenstat from New York City. The second hour of Bloomberg Surveillance. Up next.
We're in a bifurcated economy.
We continue to see the consumer spend in the marketplace on goods and services.
The labor market is solid. You're seeing solid overall growth. It's the cracks beneath the surface that we're watching.
There's no reason for the Fed to move quickly, particularly given all the policy uncertainty.
There is so much uncertainty, and there's so much being cranked into the market from a policy standpoint from the administration that you almost have to sit on your hands and say, we need to wait and see.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Coming into Wednesday at all-time highs. The second hour of Bloomberg Surveillance starts right now with equity futures pulling back from those records just a little bit. We're down 0.1% on the S&P. On the Nasdaq 100, we look a little something like this. We're down by around about 0.1%. On a small caps, the Russell, negative by 0.6. Your day ahead shaping up as follows. Later on this afternoon, 2 p.m. Eastern Time. Do you need to reschedule the nap? 2 p.m. Eastern Time, the Federal Reserve minutes. BNP Paribas with the line of the week so far. Comfortably numb. That's the Federal Reserve at the moment, comfortably numb.
Not really being forced to move in any real capacity, and they can make certain rhetoric, but right now the economy and federal policy, fiscal policy is more in the driver's seat than monetary policy. The key question that I have is, how high is the bar for them to make a mistake, a real mistake, where potentially you have a reacceleration of inflation that has remained above that 2% target that the Fed has for 46 straight months, the longest streak going back to the early 1990s.
And do tariffs make things worse and not better? Governor Chris Waller of the Federal Reserve says he'll look through it. Does he have some company on the committee? Because we could get 25% import tariffs on autos, semiconductors and pharmaceuticals by early April, according to the president.
According to the president, it'll be in the neighborhood of 25%, and that could come as soon as April 2nd when he can make that announcement. Remember, April 1st is when his team is supposed to submit all this work they're doing at looking in potentially the trade imbalances the U.S. sees with partners. So you can add April 2nd to the calendar. March 4th, remember, that's the deadline on the pause for Canada and Mexico. And March 12th, of course, is the deadline for aluminum and steel. At the same time, the market is shrugging all of this off.
I feel like Pink Floyd should be the running theme today because comfortably numb. We talk about that with the Fed officials. We could talk about that with the market when it comes to some of these tariffs because right now, no one is taking this seriously. They are not seeing this as the end point, just the starting point.
Yeah, and Europe and European stocks aren't taking it seriously either. Looking at the banks up by 18% so far year to date. Autos up by close to 10% year to date. Basic resources up by 7%. Energy up nicely as well. Every single industry group on the Stock 600 is positive for the year, with the exception of utilities, which are down by about 0.1%.
And this comes from the optimism that maybe there'll be a reinvestment and fiscal investment in Europe at a time where they're still benefiting from the dynamism of the U.S. economy. Key question here is, are people going to have a wake-up call with these tariffs, or are they noise and a negotiating tool to some sort of end?
The rhetoric and the panic amongst European leaders is not playing out to the market. When you look at the financial markets in Europe, it's almost like Donald Trump is trying to make European stocks great again. There is a mismatch between the concern that there is in Brussels, but actually what is playing out in markets.
So Rheinmetall, a defence stock over in Europe, is up by more than 50% year to date. Speaks to exactly what you described. But then you look at the autos. So on the one hand, defence stocks are taking all of this seriously. On the other hand, the autos don't seem to be at all. The autos over the previous 7 days before today, up by around 8%.
A lot of the auto manufacturers in Europe manufacture in the U.S., so there's that. That's a big component. The other component is if you have job cuts, which weren't allowed for so long, that's going to bolster the valuations at places that had really reached rock bottom, according to a lot of valuation models. So people are looking at this as a valuation story as much as it can't get much worse. I will just say that this statistic coming out of the Financial Times, that German trains were less on time than the UK train system, which gives you a sense of just how far things have fallen, given that Germany was known for the efficacy of their train system.
You're really kicking them when they're down, aren't you?
Well, I personally experienced this, where I was...
Oh, your train got cancelled?
Well, one of the trains was missing, so we had a bus instead. And I was shocked because it was, the epicenter of the train world.
We said this about 20 minutes ago, that you can start buying when policymakers start panicking. Is that another reason for policymakers to panic in Europe?
Well, it seems as though there is motion and there is discussion, and you're seeing that in the bond market. ECB officials, Isabel Schnabel, who is known as a hawk, actually came out and said maybe it's time to stop even thinking about raising rates and at least pause them. So if that's panicking, maybe so.
The euro, 104.24. Equity futures just a little bit softer on the S&P. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth with stocks near record highs. Jennifer Flitton of Invesco as Elon Musk defends Doge. And former NEC Deputy Director Everett Eissenstat on the trade uncertainty. We begin this hour with stocks fairly steady as traders look past the president's latest tariff threats. Alicia Levine of BNY Wealth expecting more volatility ahead, saying, quote, the direction is up, but tails are fat. The market has begun to price in inflation risk from tariffs and the extension of tax cuts. Alicia joins us now for more. Alicia, good morning.
Good morning.
Where do you see that inflation risk being priced at the moment?
So it's sort of this relentlessly flat market, this unsatisfying market where it's clear that the market is focused almost entirely on inflation risk, almost to the absence of anything else here. So whether that comes as part of the tariff conversation or other pricing, it's just the market hasn't been able to really get going this year. We didn't expect to have a huge year in equities in the U.S. this year, simply because we're coming off almost 50% over the last 2 years. And there is some digestion. We think it's earnings that's really going to drive the market this year. But it's sort of this like relentlessly flat experience where it's unsatisfying. Yes, we had a new high yesterday, like just over the goal line in the last minute of trading. But at this point last year, we had 11 new highs in the S&P. So we're kind of struggling along, waiting for direction. And it's unsatisfying. It's an unsatisfying market with a lot of activity underneath the surface. So financials are flying. Tech is sort of, lying down sitting out the quarter for now. And so that's unusual for the market. But you have a lot of activity in other areas. It's just on the index level, it just feels unsatisfying.
You said a lot of things, and let's unpack some of them. Morgan Stanley would agree with you that right now yields are not a driver of valuation. It really is the earnings picture. I'm just wondering, from the earnings side, is that where you expect tariffs to be most punitive, that it could affect margins in a more material way going forward, both in the longer term and also just in the short term as companies prepare?
So let's go back to your conversation about Europe, right? The headlines are terrible, policymakers are unhappy, and the market is doing quite well. We have to separate the conversations on policy for what's going on with the market. In the end, the earnings hit from tariffs, if it's a 10% tariff, is actually not that high. So that's why the market's hanging in there. And it's very interesting because both in the U.S. and Europe, not taking these conversations about 25% tariffs all that seriously. Because the truth of the matter is the U.S. has a massive trade deficit with Europe. The pain will not be felt in the U.S. if the tariffs happen. The pain's going to be felt in Europe. That's why this trade is very interesting. Nobody thinks they're actually going to happen and that they're simply a negotiating tactic. Both markets are telling you that. The market that's most susceptible, though, in terms of an earnings hit, is in Europe, not in the U.S.
And we'll get to Europe in 1 second. But you point to the earnings and you point to where you have seen robust deliveries, which has been in the financial sector, and some of the others. How much are some of the hopes and dreams of deal making, et cetera, coming to fruition versus still the promise that's far off?
So I think it's still a promise. I don't think we see anything yet. We heard conversations yesterday that the FTC is going to take it slowly as it thinks about where it wants to be in this administration and accepting M&A. I do think, though, it's simply just a better environment for the smaller companies for M&A. In the end, if you have a better head at the FTC and a friendlier environment towards deal making, you go lower cap and mid cap. That tends to do really well. You're not having mega cap by each other, so that's not going to happen. So that's where you get the sort of the animal spirits issue and the deal making and earnings coming in strong. You can still have a fine year. Almost more like the textbook, well, equities are up 7 to 10% a year. We think it's that kind of year. It's going to be hard to blow it out because you need the earnings to move the market from here at 22 times forward earnings.
You say this year is going to be all about inflation risk versus growth upside.
That's right. That's the conversation.
At what point does the market need to see that growth upside? Because you think TCJA extension is going to be noisy and drawn out.
Right.
And it might be an end of the year or next year story.
So that's why it's going to be like a relentlessly frustrating market, because the relief will come on the fiscal side and finding the pay-fors in order to drive this forward. In the meantime, we have the conversations about the tariffs and the other policies. And so it's the conversation is about inflation risk versus growth upside. That's it. And so depending on what's happening, that's where the market is trading. And so you'll see overreactions in either direction. I think that the extension of the tax cut is going to be difficult with a one-seat majority in the House. So you're going to be hearing, it's going to be a lot of noise. They'll be negotiating in the press. They'll be negotiating publicly.
When it comes to the tariffs, Trump yesterday was also talking about there's going to be all these companies announcing coming back to the United States, production here. That's that growth upside. Do you start baking in a lower corporate tax rate?
I don't think you can bake in a lower corporate tax rate here. So our estimates for the year do not include that. That is going to be a tough ask, because if the basic point is just to extend the tax cuts, that's $4.5 trillion. Then you're adding on no tax on tips, no tax on Social Security, all the others. and forget the 15% corporate tax rate on manufacturing here in the U.S. I think that's going to be a hard one to get because you have to pay for it in some way. And we've heard the Treasury Secretary say there will be pay-fors.
Let's finish on where the leadership is right now. It's the banks. The banks that you mentioned in the United States on the S&P up by 12%, in Europe up by something like 18%. Do you think this could be a period of sustainable leadership for the financials?
It depends on the regulatory picture. So I think for a long time, after the global financial crisis, the regulatory structure in a sense turned the banks into utilities. Regular earnings, no real upside, and no leverage in how you can run the business. I think the promise of deregulation for the financial sector is both increasing earnings and therefore the multiples. And the sector stops becoming something of a utility. Too big to fail. We need them, but we don't. They're too difficult.
It sounds like you've got your doubts on this sector. Is that fair?
No, I don't have my doubt. I'm actually very positive on it.
Okay.
I think we're actually seeing a sea change, and that's why you've seen multiples move higher and the outperformance of financials.
So you stick with it?
You definitely stick with financials. We like industrials here also. We like cyclicals here. We still think there's growth here. We're looking for 12 to 14% earnings growth this year. That's why we think the market's ending around 6,600. We think we'll get there. Very hard to get multiple expansion, though, from the top line S&P coming in at 22 times forward earnings, with tech looking to take a breather.
It's a good story to tell. Alicia, it's good to see you.
Thanks.
As always, appreciate it. Thank you. Alicia Levine there of BNY Wealth. Equity futures recovering some this morning, just about negative on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Trump's antitrust chiefs at the DOJ and FTC say that they will follow the tougher U.S. merger rules adopted under President Biden. It surprised critics who had been hoping for a rollback. Agency staffers received memos saying that they will be keeping the rules, signaling some continuity with the previous administration's stepped-up competition efforts. Ford has eliminated stock award bonuses for many of its middle managers. It's an attempt to boost performance amid declining profits and high costs. Ford is forecasting a year when earnings before interest and taxes will fall by at least $2 billion. It's also overhauling its EV unit after projecting losses of $5.5 billion this year. Elsewhere, Citigroup has lifted CEO Jane Fraser's total compensation to $34.5 million for 2024. That's up a third from the previous year. This as she continues to drive a plan for higher returns at the Wall Street Bank. That makes Fraser's raise now among the biggest of CEOs of large banks. And that's your brief, John.
Hey, Danny, thank you. More from Danny in the next 30 minutes or so. Up next on the program, cutting waste.
The overall goal is to try to get $1 trillion out of the deficit. And if the deficit is not brought under control, America will go bankrupt. This is a very important thing for people to understand.
That conversation just around the corner with Jennifer Flitton of Invesco from New York City this morning. Good morning. Set the alarms around this time tomorrow. This conversation. Secretary Scott Bessent of the Treasury, 7 a.m. Eastern Time, live at a studio here in New York City for 25 minutes on the state of the economy, the outlook for tariffs, for taxes and regulation, and a whole lot more. Secretary Bessent coming up tomorrow morning, 7 a.m. Eastern Time, right here live on Bloomberg Surveillance. Under surveillance this morning, cutting waste.
The overall goal is to try to get $1 trillion out of the deficit. And if the deficit is not brought under control, America will go bankrupt. This is a very important thing for people to understand. A country is no different from an individual in that if an individual overspends, an individual can go bankrupt, and so can a country. And the massive waste, fraud, and abuse that has been going on, which is leading to a $2 trillion a year deficit. That's what the president was handed.
So here's the latest this morning. Elon Musk and President Trump on Fox News defending Doge and cost-cutting initiatives. The president is set to deliver a keynote speech to global business leaders at the Saudi-backed Future Investment Initiative Summit in Miami later on today. Bloomberg's Tyler Kendall joins us now from Miami. Tyler, walk us through what we can expect at this conference and ultimately from the President of the United States.
Well, John, you'll recall that the week that President Trump took office, the Saudi crown prince said that Saudi Arabia would increase investment and trade in the U.S. by $600 billion. That was considered to be a pretty big pledge over 4 years, considering it makes up about 55% of the country's GDP. President Trump said that that wasn't enough and that instead he wanted to see that increase to $1 trillion over that same time period. Experts tell us that that is highly unrealistic, but it is still drawing many U.S. business interests here to Miami that could benefit from this increased flow of capital between the two nations. And there really is a sense on the ground here that the Saudis would like to focus on areas of agreement between the two countries, including potentially investment when it comes to artificial intelligence and advanced manufacturing, instead of disagreements that are hanging over the balance, such as President Trump's plans when it comes to the future of Gaza, something that we know many Arab leaders, including Saudi Arabia, have disagreed with. But I had the chance to catch up with one foreign policy official who's here at FII, just came back from the region, and they told me that the general sense is that the Saudis feel like they now have a more direct line of contact when it comes to President Trump compared to what was often an interagency approach under the Biden administration. And it is clear that we are going to hear a lot about strengthening ties today when President Trump takes the stage at 5 p.m. Eastern, but we're still going to be looking out if any of those points of contention come up as well.
We'll hear from the president a little bit later this afternoon. Tyler Kendall, thank you. We mentioned this in the previous hour. The Saudis seem to be the epicenter of everything at the moment. The talks in Riyadh just yesterday between top US and Russian officials. In Davos, Switzerland, at the World Economic Forum, how many panels did you see with a prominent Saudi official on that panel?
So my question in Davos and right now is, how much is it because they've got the money and they want the international clout and they're really leaning into this and they're viewed as a neutral player that has access to a lot of the relevant parties as both an oil major as well as a tech investor pretty much across the world? How much are they trying to use this moment to really have more of a world power type status than they've had traditionally as they try to diversify their economy?
Absolutely. And it is a 180 at the start of Trump 2.0 as opposed to Biden. Remember, Biden called the Crown Prince Mohammed bin Salman a pariah and was going to make the country a pariah. And my reporting was that it took a number of individuals around Biden to finally say, we need to deal with this individual. We need to deal with Saudi Arabia and the kingdom, especially since Russia's invasion of Ukraine. But Trump, day one, wanted that bilateral relationship back in focus. And you know he needs to really lean on Mohammed bin Salman, whether or not it's for Gaza, whether it's for Russia, or whether it's all this AI infrastructure spending into the United States.
The previous president got a reality check from the energy market, which led to a fist bump. Do you remember that?
And it led to me traveling to Jeddah in the scorching heat in the summer. I think when Trump goes to Saudi, it's going to be in the wonderful winter months.
They've got to consider the temperature for you, of course. That's what this is all about. Jennifer Flitton of Invesco joins us now for more. Jennifer, we won't talk about that. I want to talk about this. Elon Musk. The overall goal is to try to get $1 trillion out of the deficit. Jennifer, where does that money come from?
Well, I think that's a great question. And we may learn more when he puts out his budget in April. Typically the president gives his State of the Union address sometime in March. And then in the first year of a new administration, April's really the deadline. It might be kicked later into April, possibly into May. But those may give us some of the first indications of where the president wants to go with the budget going into the next fiscal year.
Jennifer, when it comes to DOGE, Scott Bessent was asked by Bret Baier last night on Fox News about where the spending savings are coming from. And he said he saw a draft that there's already $50 billion. Do you think that's accurate? Already 1 month in, they found $50 billion that they're saving?
Well, I think it's more than 1 month in. I think a lot of this has been prepared during the transition, even for the last year. I mean, I think it's really important to note that the president's former OMB, Office of Management and Budget Director, Russ Vought, is back in his office. He has been very busy over the past several years. I think a lot of this is sort of known to them going in. I think there's a reason why he's targeting the places that Elon Musk is targeting.
When it comes to government spending, we're less than 2 weeks from running out. Do you think we're going to see a shutdown on March 14th?
That's right. I think we're 10, 11 legislative days until this March 14th deadline. We're so focused right now on this House budget resolution and the reconciliation instructions that have to be included in that resolution to go forward on tax reform, and energy, defense, immigration. And we're not really focused right now on appropriations. Is it possible that they just kick the can for the rest of the fiscal year because they can't come to some agreement with the Democrats, I think that's very possible.
How much control right now, Jennifer, does Donald Trump have over the Republican Party at a time where all of his nominees pretty much have gotten through?
Right. I think it's pretty clear that he has a strong grip on this party. I think the reconciliation and the House budget and the Senate budget coming together on some joint budget resolution that has to be passed in order to move forward on reconciliation is going to be a real first test of where his legislative hold is with a very tight margin, especially in the House.
That's where I was going with this, Jennifer. How much is this really up to Donald Trump to come up with some sort of budget agreement that the Republicans will then push through versus what Ed Mills was saying, which is that some of the DOGE efforts, et cetera, are to cover the fact that probably they're not going to be able to cut enough costs in this budget to offset some of the expenditures in tax cuts, et cetera.
Yeah, I think Ed made a really good point. I mean, there's a vibe that has to exist. Last night, that interview on Hannity between Musk and Trump, which was very unconventional, that was a messaging tactic. That was intended to go out to the American people as the audience, right? Not just the MAGA base, not just the Republican Party, but those new voters that came in and supported Trump. I mean, it's why some of his numbers as far as trust and faith in where the president's going on in certain policy areas is so strong right now. And I think he's looking to bolster that. And going into this reconciliation debate, going into this final joint House budget resolution debate where the White House is going to have to weigh in, it's going to be really important that he has a strong support of the American people going into that.
Was the message then to Capitol Hill Republicans, go for the big one beautiful bill, because I have cover here when it comes to spending cuts?
Yeah, go for whatever budget resolution you can actually get passed, because the debate on this reconciliation has to start moving here pretty quickly. It looks like Thune is going to put this, the Senate Majority Leader is going to put this on the floor this week. That's going to require a real vote-a-rama, and Democrats are going to bring in a lot of amendments into that debate that could make Republicans take some tough votes. With a joint budget resolution, they're going to have to do that again. So the House is going to come back next week, and we're going to see if they're able to get a budget resolution across the floor, or if the Senate's going to have to feed them what they've been able to pass.
Jennifer, a busy few months ahead of us. Looking forward to covering it with you. Jennifer Flitton there of Invesco. You know how this conversation goes. The deficit's too big, north of 6% in 2024. What can we do about it? Well, we won't touch entitlements. And we won't touch defence spending, and that's north of $800 billion. I now wonder, though, whether we can really continue saying that on the latter, that on defence spending, whether that's actually in play, whether actually this administration is willing to cut back.
Well, they're going to go try to Dogeify the DOD, which I know is next on the list when it comes to Elon Musk. But Trump cannot really go after Medicare and Social Security. It was a campaign promise. But this is going to put, to your point, Republicans on Capitol Hill in a really hard place, especially those fiscal hawks who are saying, if we're going to add more into TCJA, including no tax on tips, no tax on Social Security, where are the offsets going to come from?
Defence stocks just slowly picking up on this story, just a bit softer so far to start the year. Coming up, we'll catch up with Norman Roule of CSIS on President Trump's push to end the war in Ukraine. That's next. This is Bloomberg. Equity futures, little change. BMO's Ian Lingen saying it's tariff fatigue. That's what it feels like, just looking through the threats. Will we look past the reality in early April if this is what we get? The Nasdaq right now is just about positive by 0.1%. With 2 hours until the cash open, let's get you some morning movers. Here's Manus Cranny. Morning, Manus.
Jonathan, good morning to you. A little bit of fatigue on the dating app side for Bumble. Look at this. Down 18.1%. The guidance was light, 242 to 248, so that was lower. But here's the kicker. The average revenue, the average spend, you looking for love? The average spend dropped to $20.58 versus $22.64. Some would say that's cheap. But Gen Z users are becoming tired of dating apps. It's more about community and gathering those around them. So we're down nearly 19%. Oxy drops. TD Cowen called this set of numbers noisy. The revenue slippage for the year down 9% at $6.8 billion. That's lighter than last year, $7.17 billion. Full year production will drop by 4%, and they took a $1.1 billion special charge in the fourth quarter. Arista, when it comes to network, the actual networks for the cloud, company down 4.2%. The guidance was fine, 193 to 197, but it's about their dependence on Meta and the level at which that business has dropped. That's the concerning point here. Morgan Stanley still say it's a buy. They have it as an overweight. They have $118 on the target. And BI have run the numbers, and they say, you look through this dependence on Meta. It's not that momentum has stalled. It's just temporarily paused. Jonathan.
Manus, thank you. Appreciate it. If that's true, credit to Gen Z, because our generation commoditized people on those apps, and that was never a good development.
So you think that they're going to bars and striking up conversations, and that's sort of the
I
solution?
hope they're learning to communicate with each other.
Maybe. I hope so, too.
I thought they were doing the opposite.
Humanity great again.
Staring into their phones and creating TikTok videos.
I see all those running clubs. Don't you see those running clubs around Manhattan on the weekend?
I do. I think that's basically the new dating app.
I think you've got to wear a black T-shirt if you're single. I think that's what they do. Do you know that? It's true.
This is advice Jonathan actually
This is actually
join a running club.
I said
really
Tom Reed,
helpful.
join a running club.
Yeah, well, and then
everyone's in shape. These are like, high status people to wake up early in the morning, Saturdays and Sundays.
Thank you.
Usually means they haven't been on a night out on a bender the night before, which means that's like someone you might want to date.
And they're all wearing OC or not Nike, right? I guess that's
I know it's the same thing about a
that's
sneakers.
the takeaway, yeah.
That's what I'm looking at.
Me too, sorry.
They're my channel checks for
100%.
Nike and
not as much for dating apps.
yes, obviously. Futures right now on the S&P, negative by about 0.1%. On our radar this morning, US Treasury Secretary Scott Bessent saying the Doge team has saved an estimated $50 billion so far, calling it, quote, a very good start. Bessent also saying taxpayers don't need to worry about the security of their private data. We'll be catching up with the Treasury Secretary tomorrow morning.
So I would say two things. Jennifer Flitton was talking about just now how they came in looking at where they were going to cut. So this $50 billion potential draft, even if it's off by a few billion here or there, she thinks is probably accurate. Second, he had said that the Internal Revenue Service, quote, is looking at an outdated IT system. That's all they're doing, because there was lots of concern over the weekend that Doge was getting access to people's tax files. And then when it comes to the Treasury Department and what potentially Doge is getting access to, at the moment, Treasury maintains this is read-only access. So a lot of hype about this, but potentially they're not getting into some of the nefarious things some critics have really thrown at the administration.
It was a fascinating interview last night with Scott Bessent ahead of our interview, where he was talking about the accounting of the Treasury Department as chief bond salesman. And he wasn't just talking about the cost cutting. He was also talking about the growth and the CBO. And he said, that's a crap measurement. He didn't use those words. That's my words, excuse me. But basically saying that they're not counting the fact that you're going to get stronger growth if you do get some of these tax cuts. It's going to be a fascinating PR pitch for the chief bond salesman of the United States of America to explain why the budget should not be a concern for people who are buying long-term bonds.
Also a pitch to his former friends in the hedge fund world, because he said, I used to read all the CBO scores and that would worry me about what was going on. But he doesn't like the way they do math because they're not taking into account other offsets that are happening within the government.
He said they assume 1.8% GDP growth, and ultimately GDP is around 3%. And that's what we should be projecting going forward. So the question we've really got to ask is, can you guarantee 3% GDP growth over the next decade, and where does that come from?
And how does that affect potential inflation? He keeps talking about non-inflationary growth. How do you then factor in some of the changes down the pike? There are a lot of questions. We'll get into all of them, and he'll give us lots of information, which is actually probably the most important information for at least this market, particularly with that 10-year yield.
Without a doubt. It's a really important conversation coming up tomorrow, 7 a.m. Eastern Time, tomorrow morning, live here in New York City. The U.S. Justice Department and Federal Trade Commission saying they will keep the tougher merger review rules adopted under President Biden back in 2023. The move disappointing deal makers who had been anticipating an easier time with regulators under President Trump. And this has been part of the story as to why people are buying The financials, the banks, not the only reason, but part of the story. The banks are up by more than double digits so far year to date.
So when I saw this, I had to think this has to be about the tech companies, because we have seen part of the Republican Party, especially the likes of Vice President J.D. Vance, really say that there needs to be tougher scrutiny when it comes to these mega tech tie-ups, and especially that they've gone after tech companies. I think the tone is changing now, but when they say they were censoring free speech. This is a weird alignment that you see between Democrats and Republicans in Washington, D.C.
Alicia Levine had a really interesting point. She said this is the big, large cap mergers, maybe not going to get through. And that's some of what people were talking about. Small caps, though, might get the boost. And that, I think, is a really interesting area to look at.
Bob Diamond on this program, the former Barclays CEO, coming on the program saying the financials, the number of banks in this country would come down from 4,500 to 1 to 2,000. A big drop, and not over the next 10 years, over the next few years.
Yeah, over the next 2 to 3 years, you could get that kind of mergers and acquisitions. And we've seen the deregulation of banks in particular. There is a real question. Are they going to allow some mergers and not others? Where kind of consistency? Where is the consistency going to come from so that businesses can have the security of making longer-term plans?
That's the latest on the banks. Let's get the latest on foreign policy. Secretary of State Marco Rubio saying the United States will keep sanctions on Russia in place for now. Sources telling us here at Bloomberg that Rubio told a group of European counterparts sanctions won't be lifted before a deal is reached to end the war in Ukraine. Elsewhere, President Trump planning to meet with the Russian President Vladimir Putin to discuss a Ukraine war settlement by the end of the month, after officials from both countries met this week in Riyadh. Norman Roule, a former senior US intelligence official, joins us now for more. Norm, welcome to the programme, sir. Welcome back. It's always great to catch up with you. We've talked a lot so far this week about who was in the room. We've talked a lot so far this week about who wasn't in the room. We haven't talked enough about where this meeting between top US and Russian officials actually took place. What's the significance of being in Riyadh, Saudi Arabia?
Good morning. Historically, summits between U.S. and Russian leaders take place in Europe, generally places such as Geneva. This meeting in Saudi Arabia cements the kingdom's role as a global node of political influence. It also says something about the Trump administration's view of Europe. Riyadh has worked very hard to build North-South relations. They have kept good relations with Russia and Washington, as well as East-West relations. They've worked on that as well over years, and this is now paying off. I think beyond that, you're looking at a country, Saudi Arabia, that routinely now sees meetings of Caribbean leaders, Central Asian leaders, Arab leaders. This is a country that has made itself, as I say, a global node of political influence.
Norm, when you look to the meeting yesterday and heard all the commentary coming out, whether it's the Russian side or the U.S. side, what would you describe this meeting as? Was it a pretense to get these two leaders in a room, or was it a reset of bilateral relations?
Well, I think it's both of those, and the rhetoric coming from the meeting is important, but not unexpected. If you're Russia, you want to claim the meeting as a success. Your relations with the United States are on an upturn. That's a powerful blow against Ukraine. It cuts Russian isolation on the international stage. If you're the United States, you need to establish a communications channel with some degree of trust with the Russians. You need to set up a framework so that negotiations can move forward. There's much being made of Ukraine being left out of the room or Europe, and that is true, and it's understandable they would feel this way. At the same time, you do need to have the two largest players to have some sort of rules of engagement and sense of the other moving forward.
Norm, Trump is still saying that he will probably meet Putin by the end of the month, as of yesterday. Well, the end of the month is next week. Even if it's not next week, he is clearly on a very fast timeline to sit down with the Russian leader. Does the administration potentially might walk into an era where they did with Kim Jong-un, where they met, but there wasn't a deal to actually sign on the table?
Possible. I think we need to also keep in mind that American-Russian relations, the strategy for such relations didn't develop in the last few days. The Trump administration apparently put a lot of time and effort into this during the period following the election and developed a general sense of where they want to go. This said, President Trump's approach to foreign policy is, to say the least, unconventional. He seeks rapid movements and decisive decisions. That's unnerving to some partners, but he's going to continue that approach. This said, moving forward with the talks, I'm not sure if a summit could take place next week. That's going to depend upon what he hears from Secretary of State Rubio and developments regarding the Israelis in Gaza.
Next week might be unrealistic, Norman, but just based on everything that you've heard from both sides and what you've heard from your contacts, do you think that we are closing in on some sort of resolution, some sort of ceasefire, both with respect to Ukraine and Russia, as well as with Gaza and Israel?
Well, the Gaza-Israel ceasefire remains in place. It's fragile. Talks for the second stage are moving slowly, not unexpectedly, given the complexity of the issues. Regarding Gaza, there is a fundamental discussion in Israel. Do you allow Hamas to stay in power? The United States and Israel say no. Hamas is pushing to do so and to exert control over Gaza once a ceasefire takes place. That has yet to be resolved to keep that ceasefire in place. But I think the hostage prisoner exchanges will continue. Regarding the Ukraine and Russia, last night, my understanding is the Russians conducted a rather significant multi-city attack against Ukraine using missiles and Iranian drones. So this conflict still continues, and I think we need to be careful about seeing an end to this conflict in terms of a ceasefire in the near term.
Norm, given your experience through a number of administrations, when you zoom out, how much has some of the negotiating tactic that have been deployed so far jeopardize some of the intelligence contacts that people traditionally have had with allies at a time where there are increasing fissures between the U.S. and Europe, as well as Canada and Mexico?
There is an interesting element of intelligence relationships. They are generally intensely non-political, and intelligence professionals pride themselves that no matter what takes place on the political level, that the engagement and the passage of information will continue. Now, when you get to the senior-most levels of intelligence services, sometimes there is a political overtone to their approach. But in terms of the engagement between friendly services in the United States, I think that's going to continue because there are professionals on both sides.
Norman, appreciate your time, sir, as always, and your insights. Norman Roule there of CSIS. If you are just joining us, welcome to the programme. Equity futures at the moment, just a little bit softer. We're down by 1/10%. Later on this afternoon, we'll have some Fed minutes for you, and you will hear from the President of the United States from Miami at 5 p.m. Eastern Time, I believe. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that the Trump administration is planning to lay off at least 40% of the workers at the Federal Housing Administration, which provides mortgage insurance. Bloomberg previously reported that the U.S. Department of Housing and Urban Development, the parent agency for the FHA, plans to discharge 50% of its workforce. Elsewhere, Baidu reported a smaller than expected revenue drop for the last quarter, helped by gains in its AI business. The Gen AI boom resulted in a 26% quarterly jump in cloud revenue. That's more than double the pace of growth during the September quarter. The rise, though, was overshadowed by signs of weakness in its core search business. The French family behind Hermès is set to receive over $5 billion in dividends after a record-breaking 4 years. About 100 heirs to the luxury fortune, which control over 2/3 of Hermès shares, have benefited from rapidly rising payouts. The family's wealth is estimated at just under $214 billion, that according to the Bloomberg Billionaire Index. And that's your brief, John.
That's some real money. It's got to be shared, though. Danny, thank you. More from Danny in about 30 minutes' time. Stock was up by about 20% last year, up 18% already this year.
Wait, seriously? It's got to be shared? So don't be
100 people in the family.
Okay, true. They each get a couple billion, and they get Hermès bags, I'm sure. They get first in line.
Well, that's what separates them being part of this big family versus Bernard Arnault, who still maintains the richest man in Europe.
You have to keep cutting it up, Bramo. Every generation just gets smaller and smaller and
wow. Look, give you that violin.
So does the violin, too.
It's cute. Oh, yeah. I was about to say. I can't find it.
Up next on the programme, more tariffs.
Have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%.
Coming up on the programme, the former NEC Deputy Director Everett Eissenstat joins us next from New York. This is Bloomberg. Equity futures just about unchanged. We go nowhere on the S&P 500. Bonds a little bit cheaper, yields a little bit higher. Up a single basis point, the 10-year 456.40. Under surveillance this morning, more tariffs.
Some of the biggest companies in the world, and because of what we're doing economically and through tariffs and taxes and incentives, they want to come back into the United States.
Have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%. We want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariffs. So we want to give them a little bit of a chance.
So here's the latest this morning. President Donald Trump adding 25% tariffs on auto, semis and pharmaceutical imports to a growing list of proposed levies. The former National Economic Council Deputy Director Everett Eissenstat writing, this represents a fundamental shift in US trade policy and it has world leaders and many business leaders on edge. Everett joins us now for more. Everett, welcome back to the programme, sir. Just a reminder for our audience who might not be familiar, but you served for the current president in his first term as the representative to the G7 and G20. If you had to explain to them now how this was different to, say, 2018, what would you say is different about this approach?
Well, first, I mean, there's a lot more tools on the table. The first administration, there were a number of tariff items, but really there are only three major actions, two of which are still in force, which is the 232 tariffs on steel and aluminum, which the president recently broadened and made covered more products in more countries, and the 301 tariffs on China, which he recently increased to 10%. We now have a whole slew of additional tariffs on the table, everything from a universal reciprocal tariff to the what he discussed yesterday, which is additional tariffs on drugs, pharmaceuticals, autos, and other items. So it's a different playing field, and it's much more complex than it was in the first term. So I think he's getting people's attention, and it's time to really start thinking about how to work with this administration to achieve some of the objectives that they're trying to achieve.
Well, if we do see these tariffs come to fruition, what is he going to use on the ones that are new to Trump 2.0? Is it 232, 301, or IEEPA?
That is a very good question, and it's an open question. He could use any of those. Some of them are better suited towards particular outcomes. For example, on autos, he had actually initiated a 232, which is a national security finding run through the Department of Commerce on autos during his first administration. It's not inconceivable that he could simply resurrect that investigation and impose the tariffs on autos under that authority. There's also a 301 authority, which he had used on China, which is country specific. That could also be used for pharmaceuticals and, of course, for semiconductors. Even though he could target a group of countries, he could do it in that way. And of course, there's also the IEEPA authority, which he had used recently when he announced authorities on different tariff, 25% tariffs on both Mexico and Canada. So these are all open. There's some other authorities that haven't been used in a long time, but I think this goes back to that fundamental point that there is a lot on the table here. There's a lot of authorities that are being used in different ways that really are restructuring the global trading environment.
There's also a lot of reasons why he may be using tariffs. His Treasury Secretary Scott Bessent talks about revenue raising, reciprocity with unfair trading partners, as well as just a pure negotiating tool. What do you think the president is doing right now? What is he after?
Well, right now, I see it two ways. One, I've thought about this pretty deeply, and it seems like he's almost got two of the fundamental underlying elements of Trump in one. One is that he does what he says he's going to do. If he says he's going to impose tariffs, I believe him. I think he's going to impose tariffs. At the same time, he's a very, very good negotiator. He's a master negotiator, and he's already gotten some concessions from other governments. They've come in, they've wanted to talk about how can we rebalance our trading relationship, and that's a dynamism we haven't had in the trade agenda for a long time. So if you bring those together, and as you said, there are many different reasons for tariffs, including potential revenue raisers. But if you bring those two threads together, I think he is increasing his leverage for a negotiation to try to get a more balanced outcome. However, I do believe that at the end of the day, there will be tariffs. I don't know what rate, and we'll have to see how the negotiations go. But until that occurs, it's going to be a very fluid and volatile environment, and one that merits a lot of watching by both business and government leaders.
Everett, since you have spent a lot of time thinking deeply and being deeply involved in a lot of this, can we take it a step further? Negotiating for what? The idea of fairer trade, is it to bring manufacturing back to the United States? Is it to overall reduce tariffs more broadly in order to have freer trade and just rearrange the trade partners that we really do business with?
I think it's both. I think there's and this was true under President Biden as well, and even under the first Trump administration, there's a belief among many leaders now that economic policy and national security cannot be separated. It used to be that trade ran in its own lane and it rarely touched on labor, environment, national security. Now national security and economic policy are fundamentally fused. So this idea of bringing critical industries back to the United States, like pharmaceuticals, semiconductors, autos, I think that's an underlying thread, and not just of this administration, but even the prior administration. But I do think there is a sense of unfairness that a lot of economies, and this is true, and I think this comes back to the WTO, the World Trade Organization, that a lot of economies enter that organization with terms that are quite different than what the United States has. We have a relatively open, low tariff rate. A lot of economies have higher tariff rates. And I think the president sees that as fundamentally unfair and would like to see reciprocity in those tariff rates. So it's a combination of things, but I do believe that on the national security side, that's going to drive a lot of this. And I believe that he really does feel that those industries should be investing in the United States and creating jobs here in the United States.
Everett, appreciate your view and perspective on things, as always. Thank you, sir. Everett Eissenstat there, the former NEC Deputy Director under President Trump in his first term. I want to pick up on the words from the President in that little piece of a clip that we played of him just moments ago, when he said that, I want to give them a chance so that they have their plant or factory here and there's no tariff. We want to give them a little bit of a chance. It takes a while to engineer a supply-side response. That doesn't happen overnight. It doesn't happen in a number of months. It happens over a period of years. How much of a chance is he willing to give them?
Two questions here. Will he push back the deadline if enough companies come to the bargaining table and start to build plants? Or is this something that is a blanket threat that will be fine-tuned depending on the industry? And to Everett's point, I thought this was a really compelling one. There are different criteria for different industries depending on how it interlinks to national security and how important it is to bring some of that manufacturing back to domestic production.
John, you made a great point, though, the other week about South Carolina, how already for Europe, it is a huge manufacturing base for BMW, Mercedes, Scout is there, Volvo is there. This is massive, and maybe potentially they just add more to those manufacturing bases. We don't know. But also, the European head of trade is in Washington, D.C. this week. He's going to meet with his newly confirmed counterpart, Commerce Secretary Howard Lutnick. Trump seems to be hinting at a deal every time he speaks about reciprocity when it comes to auto tariffs between Europe and the United States.
Did the Europeans actually offer to drop their tariffs on autos? Can we get that confirmed? Maybe we can have that conversation tomorrow morning with the Treasury Secretary, Scott Bessent, live on Bloomberg Surveillance at 7 a.m. Eastern Time. In the next hour of Bloomberg Surveillance, we'll catch up with Liz Young-Thomas of SoFi, Oliver Chen of TD Cowen, Matt Luzzetti of Deutsche Bank, and Thierry Wizman of Macquarie. From New York, this is Bloomberg.
Medium term, it is really hard to make an argument that doesn't favor the U.S.
We need to be conscious of the fact that U.S. markets are trading at a 20% premium.
Retail investors are now a little bit more bearish, institutional investors are a bit more bullish.
If you are a stock index that's exposed to globalization, then there needs to be a higher premium.
From an index standpoint, you may not see as much excitement this year, but at the individual stock level, you could see a lot more excitement.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz and Annmarie Hordern.
In the last 24 hours, transatlantic all-time highs. Record highs on the S&P 500 stateside, record highs on the DAX over in Germany. Equity futures this morning negative by just 0.1% on the S&P, staring down the barrel of more tariffs and just shrugging. These are the proposals right now. Early March, 25% tariffs on Canada and Mexico. Mid-March, 25% tariffs on steel and aluminum. Then into April, 25% tariffs on autos, on chips, on pharma. As each week passes, this list gets longer.
And expect it to get longer as people ask him questions about further tariffs, and he'll say, I'm thinking of something in the 25% range. We keep coming back to this, and Annmarie, you've made a great point of this. There are three prongs to the potential goals of these tariffs: seeking reciprocity, negotiating some sort of lower tariff and fair regime, or potentially bringing manufacturing back to the United States. Those three prongs are going to be really important to assess to figure out how realistic some of these tariffs are.
And when you hear the president speak about tariffs and the reporters ask him the questions, they'll throw out a sector or a material, and he will say, yeah, I'm thinking about that too. It feels like everything is on the table when it comes to this administration because they're going back to these three prongs, one of them being reciprocity, which hits hard. Everyone you talk to says it needs to be fair and fair trading. Also, Ed Mills made a great point. It's how much of this is cover for Republicans on Capitol Hill so they can go into expanding TCJA and even adding on more tax cuts.
They've got a tax plan to put together. That's going to be a huge effort with some very narrow margins in Washington.
Which is a reason why Scott Bessent, who we're going to be speaking with tomorrow, is going to be really key in giving a message that people can digest in the bond market, because the bond market is less interested in the tit for tat on the tariff side and much more interested in the budget deficit and what the payments are going to be, what the offsets are.
The top bond salesperson in the country, according to Scott Bessent himself.
Yeah.
I love that line. How many times are we using that tomorrow?
I think that we have to. I think that we
That's
have
the
to
introduction.
That's
the introduction.
Absolutely. I mean, this is the person, and he's targeting
perfect.
what range of the 10-year.
And he's also calling for a permanent extension of TCJA. So that means, depending on how you score it, now the math can get fudgy, but depending on how you score it, that could mean a lot more trillions added to the deficit.
The Treasury Secretary tomorrow morning, right here live on Bloomberg Surveillance, 7 a.m. Eastern Time. If you are just joining us this morning, equity futures a little bit lighter. We're down 0.1% on the S&P. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi with global stocks rising, Oliver Chen of TD Cowen ahead of big box retail earnings, and Matt Luzzetti of Deutsche Bank on why the Fed's patience might be wearing thin. We begin this hour with stocks on both sides of the Atlantic at or near record highs as investors shake off President Donald Trump's latest tariff threats. Liz Young-Thomas of SoFi seeing broader opportunities ahead, writing, the US is not the only game, and tech is not the only game. Don't miss opportunities because you're stuck staring at the same groups that padded your portfolio up until this point. Liz joins us now for more. Liz, welcome to the program. We're all looking at Europe. Massive outperformance there. The financials, the banks on a stock 600 up by close to 18%. Liz, what's your advice this morning for people watching this program that might have missed it? What should they do now?
Well, I don't think you've missed it, and in a sense that we've been waiting for Europe to come back for the better part of 15 years now. And the debate has really been, is Europe cheaper than the U.S. for a reason? And I think the answer to that for a long time was yes. The thing that I've actually been focusing on more than Europe is China. And if you look at the opportunities in China and even just some of the larger ETFs out of China, the Internet ETF and the large cap ETF doing much, much better than the S&P, and actually the Internet ETF even outperforming the European ETF. So the point here being that we've had this era where everybody has focused so much on the U.S., and rightfully so. We've had 2 full years of over 20% returns in the S&P, led mostly by technology, communications, discretionary, all the usual suspects that we know about. And now we're getting to a point where we've got central banks moving in some different directions. We've got steady fundamentals in the U.S. economically and on an earnings perspective, but now we have other regions perking up, and China in particular showing commitment to really stimulating their economy until they get what they want, which is to meet their growth numbers.
So Liz, let's talk about China a little bit more. On the data front overnight, home prices not as bad as some people might have thought, signs of stabilization there. We heard from a miner, BHP Billiton, earlier this week. They talked about green shoots. Heard from a hotel group in the last 24 hours, IHG, who talked about maybe China bottoming out as well. Liz, with all of that in mind, how do you think people should play the China story when maybe they've tried to get in before and been burnt several times?
Yeah, I mean, I think that's happened to people in China and in Europe, so I understand the feeling. And it's happened to me in Europe, too. I tried to get in a few years ago and got burned. It went nowhere. So I understand the bruises that I think investors have taken. And make no mistake, China still has progress to make. They still have problems over there. And the stimulus that they've announced so far has not been entirely successful at stimulating what they need to, which is the consumer portion of their economy and to save the real estate portion of their economy. So I still think think more needs to be done, but I do think we will hear more from them. As we start to get news of perhaps stimulus that targets the consumer directly or that targets the real estate sector directly, I think that's where you see things really perk up in a durable fashion. We've already seen some volatility in the Chinese markets. After the stimulus that was announced last fall, we saw this big surge in a lot of those stocks and then kind of a fall off afterwards. I actually believe China bottomed before that. So bottoming, as we know, is a process. It's not just a moment in time. And China had been going through what I believe to be a bottoming process before that first round of stimulus was announced. Now, that first round of stimulus, again, was not entirely effective. They had to announce some more, and I still believe they'll have more to come. But I think we're on the way to finding out that things are getting a little bit better there. And if not, they will get the support that they need from the government.
One of the reasons why a lot of people have said that China is uninvestable is because the policy structure is less clear there in terms of how much they champion their businesses. And you add on top of that a very deliberate effort by the United States to isolate China and interrupt some of the supply chains. How do you discount those types of just structural arguments against investing in China right now?
Yeah, so when we issued our 2025 outlook, this was in mid-December, we had China listed as a contrarian play for obvious reasons. We knew that the new administration would go after China and perhaps increase the tariffs that were already in place. So I want to be very clear, this is not something where I'm saying we're investing in China and we're bullish on China for a 10 to 15-year period. This is something where if you're looking at your investment portfolio and you are, much like many investors, overweight U.S. technology, overweight all of the stuff that got us to this point, it's time to start looking outside of those baskets. And some of that might be still in the U.S., in other sectors in the U.S. that have not kept pace, things like healthcare, financials, industrials, things that are showing good earnings growth, even some of the communications names that are not so much in the headlines as usual, but then also looking outside the U.S., because another contrarian viewpoint coming into this year was that the U.S. would actually underperform international. So that includes things like China, and if you're getting it at a really nice discount, getting it pretty cheap compared to U.S. stocks, and things like Europe also getting pretty cheap compared to U.S. stocks. Valuations are very important in an environment where yields have remained high and are expected to stay high because of the sticky inflation for the foreseeable future.
Liz, a lot of people were talking about this last year, at the beginning of last year, that tech would underperform and that everything else would catch up. It seems like people are reviving that concept now because of some similar and some different arguments. Why is it this year that people are going to step away from tech giants that have been hit or miss more generally, but still are at the epicenter of a transition that a lot of people seem to have faith in?
Well, first of all, you think about just the timeline of events, right? I mentioned before we've had 2 full years of above 20% returns in the S&P. If you just look at that over a historical context, usually when you have that strong of performance 2 years in a row, the third year is still positive on average, but not nearly as positive. So we would expect something more like normal returns this year. Let's call that high single digits, low double digits. So that's part of it, right? It can't continue forever. The other part of it is that a lot of what drove tech to this point was the semiconductor play and the theme of AI coming to life. We are still very much in the infancy of that theme, but I think we are transitioning into one of the next phases, and that next phase is going to take us towards other types of companies. In the U.S., if we're looking at just technology in the U.S., I'm actually more bullish on software and things like cybersecurity than on semiconductors this year, because I do think that we're making that transition. The other part of that transition is that competition rises. So if we're looking at other types of companies, and obviously we know about the news that came out of China a few weeks ago on DeepSeek, if we're looking at other types of companies, there's bound to be heightened competition around the globe. Other companies, other regions are going to get in on this game, and we're going to have to watch for opportunities outside of the ones that we've been focusing on up until this point.
Certainly seeing that to start 2025. Liz, appreciate your time. Liz Young-Thomas there of SoFi on its equity market, not just stateside, but worldwide. Started this year. We've said this repeatedly on this programme over the last month or so. Just eating up and beating up consensus trades. The dollar weaker, not stronger. Bond yields lower, not higher. Europe outperforming the United States, not underperforming the United States.
So we'll have to see whether it's churn and basically people looking to upend crowded positions and whether this is a trader's market or whether this is the beginning of a new phase where you do get that true broadening out and outperformance of region outside of the United States.
Nasdaq futures just about unchanged this morning. Equity futures on the S&P just a touch negative. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump said that he will likely impose tariffs on car, chip, and pharma imports of around 25%. He said to expect an official announcement around April 2nd. Trump said that he wants to give companies time to come in before announcing new import tariffs, adding, when they have their plant or factory here, there is no tariff. Elsewhere, Ford eliminated stock award bonuses for many of its middle managers. It's an attempt to boost performance amid declining profits and higher costs. Ford is forecasting a challenging year with earnings estimates to fall by at least $2 billion. Ford is also overhauling its EV unit after projecting losses is up to $5.5 billion this year. And Elon Musk told Fox News that he's aiming to bring back 2 U.S. astronauts stranded on the International Space Station in about 4 weeks. The SpaceX CEO said that his company is accelerating the return of the astronauts per the president's instructions. Musk accused the Biden administration of leaving the astronauts at the space station for, quote, political reasons. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. How many times have we said this? I still can't believe that isn't like one of the nation's top stories and hasn't been for the last 6 months plus.
There are 2 astronauts who have been stranded for months in space. What are they doing all that time? Are they watching TV?
No, they're working on the space station.
Okay, at a certain point, though, you go, a little stir crazy.
They're meant to go up there for a few weeks, right?
Exactly. And then all of a sudden, 8 months later, it's like, really? We have to look at each other again?
Incredible. Absolutely incredible. Up next on the programme, the Morning Calls Plus, Oliver Chen of TD Cowen looking ahead to Walmart earnings. That conversation coming up next. And why Bramo will provide some therapy to the astronauts once they get back down to Earth. Is that the plan?
Oh, yeah, I guess so.
They're looking at the whole solar system.
Yeah, it's,
Lisa's got complaints.
It's amazing. Come on. Let's move on.
Equity futures on the S&P 500 negative by just 0.1%. The opening bell about 1 hour and 15 minutes away. Let's get you some morning calls. First up, Wells Fargo analyst Mike Mayo raising its price target on Goldman, expecting improved margins across its 3 business lines. That stock is just about unchanged in the pre-market. Your second call from Argus upgrading Airbnb to buy. The analyst citing long-term growth potential. That stock is higher by 0.4%. And finally, Bank of America lowering its price target on General Mills, citing the company's failure to officially update its fiscal 2025 financial outlook. That stock down by just 0.1%. Let's turn to retail. Walmart kicking off its big box earnings tomorrow. Oliver Chen of TD Cowen raising his price target to 110, seeing more potential upside thanks to holiday sales, general merchandise strength and e-commerce grocery gains. That stock is higher by about 0.5%. Oliver Chen of TD Cowen joins us now for more. Oliver, good to see you.
Great seeing you too, John.
I'm going to ask Lisa's favourite question. She asks it all the time. We're used to sitting and looking at Walmart and saying, trading down, the consumer's trading down. If Walmart's doing well, maybe the country's not doing so well. Oliver, is that the right way to look at Walmart anymore?
We are excited about what's happening at Walmart. They're getting high-end customers, but they're also executing for value. So all of America is looking for value. That's really working with traffic at Walmart, and we're in a very volatile time where they have a lot of negotiation power relative to suppliers. The bottom line is the discounts they're offering and the pricing they're offering is quite compelling. Plus you layer on technology and the marketplace model too.
Okay. People talk about value, and I try to understand what this word means, because it doesn't mean cheap prices anymore. And you can buy a Birkin bag on Walmart's website. I was actually looking at that, not that I'm buying a Birkin bag, but I was curious where it was being sold. I'm just curious if Walmart is still a barometer of lower income Americans, or to John's point, if it is a broader tell on just how much you can consolidate market share in a company that's got enough heft and enough negotiating power.
Yeah, the beauty of Walmart is really both, because you have combination retail, meaning the marketplace model plus heritage core retail. But Walmart is America. 4,000 stores, 90% of America within 10 miles of a Walmart. And the consumer has been strong. Low unemployment and cash on the sidelines. So they've been executing well. The consumer's also been very selective and looking for deals and bargains. So you get a grocery leader at low prices, plus you can get that Birkin bag from Hermes if you go online at the marketplace. And you get higher household income shoppers coming to Walmart because you don't have to go into the store. There's Walmart Plus, there's curbside pickup. So combination retail is a theme, and you're combining needs of eggs and water and meat plus wants. That's the theme we like. We also like Costco, too, and BJ's.
I just love the idea of save $3 of milk and then go buy a $30,000 Birkin bag. But I'm just curious how much Walmart is taking market share away from other retailers. You talk about the ones you like. Walmart shares up 15% so far this year. Target, one of the biggest losers over the past 3 months, and is down some 3% so far year to date.
Yeah, it's that need plus want dynamic. So Target's mostly discretionary. Furthermore, a big chunk of Target is home and apparel. This consumer's been a lot more cautious and selective. What Target really needs to do is increase the speed at which their supply chain operates to adjust to this new normal of a very rapidly changing consumer.
Well, Oliver, they screwed up their inventory management as well, and we've seen that a number of times from that company, which raises an important question going into the next couple of quarters. Tariffs are on the radar for pretty much everyone, on the horizon in a major way. How are these companies managing their inventory with that in mind?
Yeah, unfortunately, Target has the biggest exposure to imports at 50%, Walmart less so at 30%, and Costco at 20%. Walmart's very well positioned, negotiating with suppliers, and also having a very good track record of supply chain management.
But isn't a lot of their supply chain within Mexico and Canada, which is potentially going to get hit in early March with 25%?
Yeah, when it rains, it pours on everybody. We think Walmart will be best positioned in terms of their ability to have the lowest prices and best techniques. And also, they've been pretty fast and agile. And keep in mind, over half of Walmart is food and grocery. That will be very helpful.
Well, Lisa mentioned Birkin bags, so if we can ask you a few questions on luxury as well. When it comes to tariffs, in Trump 1.0, it was the luxury sector that was getting hit from Europe, at least for a short period of time. These luxury handbags, leather goods, are they going to be on the chopping block when he talks about reciprocity?
Well, we're still bullish. What's happened with the resolution of the election is the wealth effect and more consumer confidence. So we recently upgraded Richemont, and that stock has done great with the Cartier franchise. This bifurcation theme being luxury stocks at the very highest echelon, as well as Walmart, that's a key theme we're following. We'll really have to watch and see what happens. Anything's possible in this environment.
In the luxury space, everyone's scratching their head. What's going on with Kering?
Yeah, lots of change there. I think the bottom line, Gucci I personally love, but it needs more theater.
We saw your loafers.
It needs more pizzazz. And it's a wonderful brand with wonderful heritage. But a lot of change is happening in luxury, lots of designers switching. So the look forward to spring and June is going to be exciting with change and more theater and more excitement. There's a quiet luxury mood in terms of conservatism, but people are yearning for louder luxury, more fashion, more expression. We'll see with all these changes. But Gucci needs more pizzazz, needs more sparkle.
Are you suggesting that Gucci got quiet at exactly the wrong time?
Yeah, a little late. Quiet's still working, Brunello Cucinelli, Loro Piana.
Sure.
But you really need the combo. And it's a little lagging, yes. In terms
so who's in the right spot at the moment? Who's got this right?
Listen, it's to be determined. At some of the shows, looking forward to Tom Brown. Zinnia's executed very well. They've been very consistent. But I guess Boring's worked. The new shows are in the spring. TBD. I still like some of the classics like Prada, and I'm wearing Brooks Brothers, American Classic. The mood here is classics with a twist. And then getting it right, jewelry, like that's a great value because bag prices and shoe prices have been inflated too much, basically.
Are you basically saying that companies should stay to their core? So if you're Loro Piana and you have always been quiet luxury, you should stay in that space. And if you're Gucci and you've done really well, say under Alessandro Michele, with loud fashion, you should stay in your lane.
Yeah, authenticity to the brand is so important. And when you think about Loro Piana and Brunello and Zegna, it's about craftsmanship, material, heritage. When you think about Gucci, you've got to add that sex seductive appeal as well. So thinking about that being said, in consumer discretionary, nobody needs anything really. So you have to create desire. And how do you maintain cultural relevance? Taking you back to Walmart, it's about the needs and the want, plus the wants. And the want world is a little tougher, where consumers are looking for timelessness right now.
When it comes to all the shoppers in the luxury space, how is the Chinese consumer keeping up?
That's been totally cautious. So that's part of our selective stance in luxury, owning Richemont, Cartier, and LVMH, which is a real juggernaut. But there's a lot of China issues which we all discuss, particularly the property market, which is overhang, and also consumer confidence and youth unemployment. So the big question, and we're all watching, is if there can be better consumer stimulus, because the past has been stimulated at the industrial side. So the demand profile is still very sluggish, and cautious optimism here. More cautious on China. U.S. has been better than expected, in part due to the wealth effect.
When you put together Walmart and Costco and Richemont and Hermes, I'm curious about whether we're seeing the same trend that we've seen over the past 5 years, which is the luxury consumer, the wealthy individual, has had lots of money and lots of confidence to spend. And lower income consumers have been much more penny pinching, much more restrained, looking for deals. Do you see that dynamic ongoing, where the strength of the consumer still lies in the upper quintile of the earners, or is it broadening out? And is there more of a willingness in lower and medium income families to spend, to look past price increases, et cetera?
We're going to still continue to see that theme of bifurcation and more pressure on the lower and middle. At the same time, we'll see real exuberance and this wealth effect at the high end. But we're also seeing trading down, where consumers are gravitating towards Costco and Walmart too. So some beneficiaries in the value segment, and then also in the upper echelons, where that consumer is pretty strong. The wealthy consumer is all about confidence and feeling good. So that this is a moment when that's working. So it's bifurcated, pressure at the low end and middle as well.
In North America, the wealthy consumer was the tourist from China, from Russia, from Brazil. That's changed a lot in the last decade.
Yeah, you've seen an increasing number of domestic consumers of luxury. I wonder how much the leadership in the White House and the style that's sort of set also imbues people with a desire to spend.
That tourism from China is not coming back. No. We've talked about that a few times.
Scott Bessent will be here tomorrow, the Treasury Secretary, and he said in his hearing he thinks China is in a recession at the moment.
Scott Bessent tomorrow morning, the Treasury Secretary, 7 a.m. Eastern Time, right here on Bloomberg Surveillance. Oliver Chen, TD Cowen. Ollie, good to see you, sir.
Pleasure to be here.
As always, thank you. Up next on the programme, Matt Luzzetti at Deutsche Bank, Terry Wizman of Macquarie, as we count you down to the latest release of the Federal Reserve minutes later on this afternoon, and anticipate more tariffs from the US administration. March and April, it's going to be a very busy time on the trade front. From New York City, this is Bloomberg. The opening bell is about 16 minutes away. Your scores look like this. Equity futures on the S&P 500 negative by 0.2%. On the Nasdaq 100, we're down by about 0.1%. Some underperformance on the small caps. The Russell is down by 0.6%. Just bear in mind, we closed yesterday at all-time highs on the S&P 500, and we've got record highs on the other side of the Atlantic as well, on the equity benchmark in Frankfurt, Germany, even with the prospect of more tariffs still to come in the next couple of months. We've got some economic data stateside. Let's get to it. Let's get to Mike McKee for more. Good morning, Mike.
Good morning, John. We've got housing starts and building permits, and it's for January, so it's a bit of an unusual month. We do see a decline in housing starts of almost 10%. Negative 9.8% down to 1,366,000 from 1,499,000. Building permits are up by just 0.1% to 1,483,000. We can get you the regional breakdown, but this month it doesn't matter as much because, remember, the fires in California were in January, so it's going to be February or March before we start to see replacement building permits and things like that really get started. And then it's going to be an issue of can they find the construction workers and how much is the lumber going to cost. A lot of questions out there for builders going forward. Yesterday, the National Association of Home Builders said that their optimism index fell quite a bit. So we'll keep an eye on the housing starts numbers, but it isn't really reflecting where we are at the moment.
Mike, appreciate it. Thank you, sir. Very disrupted, those figures, as Mike suggested. We'll catch up with Mike in just a moment to talk about some of the Federal Reserve talk that we've heard over the last couple of days, including the Fed minutes that you will see later on this afternoon. Toll Brothers maybe gives you a cleaner read on what's happening here for the home builders. They missed expectations for quarterly home orders. High mortgage rates, Lisa, housing costs, the affordability squeeze that's taking place for the home builders hitting that stock.
Yeah, and you're seeing that stock down some 6% or almost 6%. Also, Lerner, one of the worst performers over the past 3 months, another home builder in the United States. You wonder if that's a tell at a time when they really are providing the bulk of the inventory that actually is moving in an otherwise absolutely frozen housing market.
UBS made the case to buy some of these names on the programme yesterday. It's been tough at the moment to start 25.
Especially if you don't have rates coming down and you have a more persistent inflationary backdrop, as well as elevated prices at a time where people are that much more sensitive to that type of price inflation and just elevated levels.
Toll Brothers down by almost 6% in the pre-market. Investors are waiting a slew of Fed speak and minutes from the central bank's latest meeting this afternoon. Matt Luzzetti of Deutsche Bank writing, while we continue to think the next move is a cut rather than a hike, recent events have raised the possibility that the Fed needs to hike rates in the second half of this year. Matt joins us now for more. Matt, it's good to see you.
Good to see you.
It's not your base case, but the chance isn't zero and the chance went up. So let's talk about why and how high that bar is for that hike.
Yeah, I think to be clear, I think that the bar is high. I think that the Fed, the next move is very much likely to be a cut. I think to get there, you need three things to happen. One, the labor market needs to become a source of inflationary pressures again. The latest batch of data that we've had on the labor market sees the unemployment rate going down, wage growth a little bit higher, payroll gains picking back up. And so the labor market is not as much of a source of downside risk as it once was. You need to see inflationary pressures picking up and accelerating. The latest data there was a little bit mixed. We saw the CPI report, which was much higher than anticipated, but that didn't feed through to the PCE data. But at the same time, we have tariff threats out there that are more than we were anticipating. And so the inflation threat is greater than we were anticipating. The third thing is inflation expectations. And the Fed is always highly focused on those. And there you have seen some upward movement. The latest University of Michigan data has moved higher, including at the short end inflation expectations. Latest survey of professional forecasters has moved a little bit higher. So just at the margin, I think that we've seen the risk of a rate hike increase for the second half of the year.
I wonder if in the meantime, if we're not talking about a hike, are we talking about a Federal Reserve that has accepted inflation at about 3% or 2.8%, given the fact that it's been 46 months since inflation has been below that 2% target that the Fed has?
It's quite remarkable. If you go back to their December SEP, they don't expect inflation to get down to 2% until 2027. That is an extraordinarily long period of time. But I think that they're telling you as well, they're not accepting the trade-offs between the labor market and getting inflation down to 2% quicker, right? So they have a 2.5% core PCE inflation forecast this year, just like us. We think that they will hold steady with their policy rate this year in order to help to bring inflation down to target over time. But yeah, to a certain extent, they are accepting of inflation that's called 0.5% that's above their target, because they would not think that would want to trigger an unemployment rate that rises by a few tenths in order to get it down quicker.
Is it enough for them to just remain on hold to get inflation on that gradual path back to 2%? Or do they have any control whatsoever over this, given that a lot of it has to do with variables well outside their parameters?
Yeah. I think if it weren't for all the policy risks out there about immigration and fiscal policy and tariffs, which is obviously a lot of risks that are really important for them, that yes, I think there was a disinflationary trend in place. We were seeing rental inflation coming down. And I would have confidence that we'd get within a 0.25 percentage point of their target this year. But those risks are meaningful. They're certainly lifting inflation, we think, this year, potentially next year. And I think that will require them having to remain on hold for a period of time here. I think for the minutes today, it'll be an interesting question how they talk about how restrictive policy is. At the January FOMC meeting, Chair Powell said that they were meaningfully restrictive. I think you've heard a lot of uncertainty from a number of other officials. Even Vice John Williams was talking about they were only modestly restrictive. A number of officials think that they're near neutral at this point in time, which we agree with. So I think that's an area where there's just a lot of disagreement on the committee at this point.
What would it take to raise rates? You're talking about this uncertainty that the Fed is going to price in potentially stickier inflation from tariffs, immigration policy. What would it take for the Fed to say, actually, now's time for a hike?
Yeah, I think you need two things and then the third wild card. The first thing is that the labor market needs to retighten. So I think you need the unemployment rate to be falling below 4%, the quits rate rising, wage growth reaccelerating. So the labor market is not just there's not downside risk, but it's actually a new source of inflationary pressures. Two, inflation itself has to accelerate. So I think core PCE has to be going 2-3% or above. They've been pretty clear that if inflation is just stalling out, they meet that with keeping policy on hold. And then the third thing will always be inflation expectations. If those are rising, it lowers the bar on those two other things. and they could have to raise rates if inflation expectations move higher.
BNP Paribas put out a note yesterday and said this Federal Reserve was comfortably numb, comfortable doing nothing. And I think you might agree with that. And what I want to understand, as they're in this period of doing nothing, how balanced are the risks? Are they balanced to the downside as they are to the upside? Is there a real risk that things could get worse as they sit there and do nothing, waiting to see the policy changes that may or may not come from Washington, D.C.?
Look, I think we have an economy that is entering this period with a lot of momentum. You know, growth last year, the consumer growth last year was strong. Consumer spending above 3%, 4.2% in Q4. The labor market was accelerating in many ways. We've seen payroll gains on a 3-month moving average basis above 200,000. Leading indicators were supportive, credit conditions, financial conditions, optimism from businesses, CEO, and other surveys hitting several-year highs. So the economy had meaningful forward-looking momentum. That is being met with a lot of uncertainty. And I think that they should be somewhat concerned that the kind of constant tariff threats, what we're hearing from a fiscal spending perspective, can turn sentiment relatively quickly if they continue to persist, and if it's not counteracted by other positive news on the economy, deregulation, fiscal policy, tax cuts. And so I think the administration probably has to balance that out a bit more.
How quickly do you think we could see some of the job cuts in Washington show up in the economic data? Is it too early?
No, I mean, if you look at the weekly jobless claims and you look at the D.C. area, it's already showing up. It was showing up in the past 2 weeks, and I would expect that accelerates. Many of these cuts look like they might be coming after the survey week for the February jobs report, so it might take until the March jobs report to get greater evidence of that. And then we have this whole batch that took the buyouts, which that probably does not show up until the September-October data because they are kept on payrolls until that period.
Do you know what it could potentially average out to? Because last year, when you look at federal workers added to the NFP, it was about north of 35,000 individuals a month. What kind of number could we see every month going forward?
Look, they've had a target of about 10% of the workforce. You know, we think about having about 2.4 million federal workers. Say that's 200,000 jobs. So that is a meaningful hit to payroll gains if and when it happens. The numbers are much smaller than that are being reported so far, and the numbers that kind of took the buyout may be 60 or 70,000 individuals, and that doesn't impact the data until later. But look, it's a meaningful amount to payroll gains when it happens, and if it is as big as kind of being that's being focused on. I would just also indicate in the near term, those buyouts could actually lift payrolls a little bit. You know, those individuals could get another job as they're currently on government. There's actually seasonality here where people would typically be retiring, but they won't because they're kept on payrolls. So over the next 6, 7, 8 months, you could actually have some counteracting forces from a seasonal perspective.
That's a great counterpoint to think about. Matt, appreciate your time as always, sir.
Thank you.
Matt Luzzetti there of Deutsche Bank. Look out for jobless claims tomorrow morning at 8:30 Eastern Time. Look out for the Federal Reserve and its minutes later on this afternoon at 2 p.m. Eastern Time. Let's bring in Michael McKee for the conversation again. Mike, look ahead to 2 p.m. Eastern Time. We've heard from some Fed speakers already. What are you looking for in those minutes?
Well, because we've heard from the Fed speakers, I don't think you're going to find a lot of guidance on what's going to happen, but maybe around the edges is what we'll see in terms of what were they saying about what they thought the administration might do. Now, this is 3 weeks ago, and obviously there have been a lot of developments since then. But were there any kind of general outlooks for what they might see and then how they might react? Did the staff give them any kind of presentation, as they did in 2018, about tariffs and what they might mean? And then look on the balance sheet side, maybe. Will the Fed have talked about anything to do with the supplementary leverage ratio? That has been a topic that's come up since then significantly, and it is possible they talked about it there because Jay Powell said that it is something they are considering changing. The balance sheet also in terms of is there any clue to when they might stop or when they think that the repo facility will hit zero? That would give Wall Street a chance to do some math on when they might stop.
Mike McKee down in Washington this morning. Look out for Mike's coverage of the Federal Reserve release of its meeting minutes at 2 p.m. Eastern Time. On the trade front, Governor Waller put this out in a speech over the long weekend. My baseline view is that any imposition of tariffs will only modestly increase prices and in a non-persistent manner, so I favour looking through these effects. Will that show up in a minute a little bit later this afternoon? On the trade front, the EU trade chief heading to Washington today in hopes of avoiding a trade tariff dispute with the United States. Terry Wizman of Macquarie writing, the period of tariff uncertainty for the euro may last longer. We'll conclude that it's still too early to say the euro-dollar has entered an appreciating path. Terry joins us now for more. Terry, it's good to see you.
Good to see you, John.
I'll take you beyond rates, foreign exchange and commodities, and just mentioned the phenomenal performance we're seeing in European equities. And this is how we started the programme this morning. Do you think the European story has just seen the worst of it already? It's all behind us, or are we whistling past the graveyard here?
I think we're whistling past the graveyard to some extent. I think that the reason why we've had such outperformance in European equities since the beginning of the year has much more to do with rotation. And having seen how well the U.S. stock market has done over the past few years and the imbalances that has caused in the allocations of various international asset allocators, it stands to reason that they would be trimming their U.S. exposure, building their European exposure. And of course, when that happens en masse across the board, that's going to lift prices. But I have to say, I see very little fundamental reason for the run-up in European equities, except for those pockets that have been energized to some extent by various policy statements. The defense sector in Europe, for example, there is a fundamental reason for why that's going up. Again, few and far between, but the broad sweep of the uprise is really about reallocation and not about fundamentals.
Well, let's sit on defence and we can talk about fundamentals. So defence stocks like Rheinmetall are up by more than 50% so far year to date. There's a big question in Europe right now about how they would fund increased defence spending, and that's in your world. That's the rates market, that's bonds, that could influence foreign exchange. How are you thinking about those things?
It's very likely, in my opinion, that this is going to be joint issuance of bonds to finance the increase in defense expenditures that needs to be done, assuming, and this is a big assume, that Europe actually wants to move towards a 3% of GDP defense expenditure, a baseline. So I don't necessarily think that at the level of each individual country this is going to impair their sovereign risk perceptions. But at the same time, we're going to see more bond issuance, and by virtue of that, that may put upward pressure on bond markets as a whole in Europe without necessarily increasing sovereign spreads. Again, assuming that this is joint issuance. I should say, however, that there's a lot of hurdles in the way of this even happening, right? First of all, we'd like to see the Germans take the lead because they're the country with the most economic wherewithal to do that. But before they do that, they need to change their laws, right? The Schuldenfrenzy, assuming I got my German correct, is the so-called German debt brake. We're going to have an election in next week in Germany. And of course, the CDU there has been very much against, historically, against loosening that brake. The Greens, the Socialists have been a little bit more inclined to do so. It would be nice to see the CDU, if they take power in Germany, loosen those fiscal restraints to some extent. And maybe they will, and then we'll get a little bit more German country-specific participation in that defense build-out. These are things that have yet to be seen. If they do happen, I think it could be positive for the euro, but we're going to have to wait a little longer, which was the essence of the note that we wrote the other day.
When you lean into the whistling past the graveyard part of John's question, I'm wondering, do you think that essentially the euro strength is over, that we're going to revert back to flows into the United States the way that it was, even though you have that long dollar long that we had been experiencing last year?
Certainly, if we get a global slowdown, the U.S. dollar can catch another wind, right? It could appreciate again. But that's not in our baseline. When we came out with our global FX outlook in December, what we had said is that the euro is likely to bottom at the end of Q1 at around 102. Okay? Because we did see positive events, more positive events coming out for the euro prospectively in Q2 and in Q3 than in Q1. What are those events? If they happen to pass, those events are peace in Russia, Ukraine, the prospect of pro-growth policies coming out of Europe by way of the German election, okay? And of course, some clarity on tariffs. If those three things come together, it's going to be very unlikely that the dollar strengthens further post Q2. Can it strengthen a little bit more in Q1 between now and the end of this quarter? Yes, it can. I think tariff noise can do that, but not a global slowdown.
There is this larger issue of whether Europe was beaten up at the end of last year because people assumed that they'd be the biggest loser from both tariff policy in the United States, as well as the slowdown ongoing in China. That story has flipped on its head. People are seeing green shoots in China and starting to invest once again at the same time that potentially some of these tariffs are negotiating tactics. At least that's the way it's being perceived. So which is it, right? Which narrative would you lean into?
It depends if you're looking at the short term or the medium term. If you're looking at the medium term, or the long term for that matter, of course, China is eventually going to rebound from these doldrums. And of course, the signals in the past week have been very positive in that regard. Of course, ultimately, there'll be peace in Russia and Ukraine. It's already been a 3-year war. Most wars don't last that long to begin with. Of course, we're going to get some clarity on the tariff front eventually. And very likely, we're going to get a policy reorientation in Europe. So I'm leaning towards the view in the medium term that most of the factors that have held Europe down politically are going to be unwound, and that's going to be the basis for a recovery in the euro. I don't want to make that call now, and I think that was the essence of the note, because there's still quite a lot of noise out there, including, as we saw last night, with the announcement, the proclamation, if you will, of more tariffs coming. And I think there's a lot of non-coherence, or uncoherence, if you will, incoherence, I guess is the right word, in U.S. tariff policy right now. But I hope that by the time we roll around to 3 months, there'll be a lot more coherence.
We keep going back to the tariff proposals on the table so far, and there are many. We've been through the calendar before. We did it at the top of the hour, March 4th, 25% on Canada and Mexico, March 12th, 25% on steel and aluminum. Annmarie, April, 25% auto, chips, and drugs.
In the neighborhood of 25%.
Could be more.
On those. It could be more, or it could be less, which, you know, that means Trump at this moment is likely in negotiating mode. And I wonder if one of those negotiating tactics is potentially concessions from Europe to increase defense spending. Could that mean less tariffs? And I think that's what Thierry was getting at.
Thierry, just a final word. Of the dates on the screen right there, through March into April, what's your baseline of what happens here with some of those proposals?
Noise and uncertainty. I don't think, well, let's go, if you'd like, we can run them down one by one.
Sure.
And I think the easiest one to call is the March 4th deadline, if you will, for the Canada-Mexico tariffs. Canada's not an enemy. Canada's a friend. It's not even a bystander. Mexico should be a friend. I think that there is a precedent here in what happened in 2018 and 2019 when President Trump at the time did almost exactly the same thing. And how did those concessions come about? They came about because Canada and Mexico came back to the U.S. administration and said, we'll reopen, we'll revisit NAFTA, we'll renegotiate it. And as soon as that announcement was made, we put to bed those tariffs. So I don't want to necessarily go through all of them. I know we have limited time here.
Sure.
But this is a good example of how things can progress going forward. Even in the case of the reciprocal tariff announcement that came out, that circular from the White House the other day, there was a section in it that said the art of the international deal. When I read that, it tells me just one thing, right? We're heading towards deal making and not permanent punitive tariffs on these countries. And that deal, just as in the case of Mexico and Canada, can take a form that we don't necessarily expect at this moment. At the time of those Mexico-Canada tariffs back in 2018, no one really understood that this would lead to a complete reopening or a complete recasting of the economic relationship, which is why, by the way, at the end of all this, at the end of the rainbow, we may actually see a much more tighter, more cohesive, wider in scope economic relationship between the U.S., Canada, and Mexico than we have now. That would be the good case outcome. And if tariffs are needed to propel those negotiations that lead to that end of the rainbow, that's great, as I see it. Okay, that could be a good outcome. And to some extent, maybe the market isn't panicking as much as it should because it sees the prospect of good outcomes on the other side.
A pot of gold and a stronger euro. Thierry, I appreciate it. It's good to see you.
My pleasure.
Thank you. Thierry Wizman there of Macquarie with the latest. With the latest on the news elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. A federal judge has denied a request to temporarily bar Elon Musk and his Doge team from accessing internal systems and removing employees at multiple U.S. agencies. Democratic state attorneys general had contended that Musk is exercising power that's supposed to be reserved only for high-level Senate-confirmed officials. Elsewhere with Elon Musk, Bloomberg has learned that his social media company X is in talks to raise money from investors at a $44 billion valuation. That's the same price that the Tesla billionaire paid for the company in 2022. The funding round would be a remarkable turn of fortune for X after Musk's takeover and overhaul caused many users and advertisers to flee. The Vatican says that Pope Francis is being treated for double pneumonia after scans revealed the condition in both his lungs. The 88-year-old has been in hospital in Rome since last Friday. Church officials now describe his medical situation as a complex picture. The Vatican has asked for prayers for the Roman Catholic spiritual leader who's been the head of the church since 2013. And that's your brief, John.
Danny, thank you. Appreciate the update. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and get you the latest, not from Washington, but from Miami, from New York City. This is Bloomberg. The opening bell is about 36 minutes away. Equity futures on the S&P a touch softer. We're down by 0.2%. Your trading diary through the week looks like this. Later on today, Fed Minutes at 2 p.m. President Trump signs another round of executive orders at 7:30. Tomorrow, Walmart earnings plus another round of jobless claims on Friday, PMIs and new Mitch sentiment. Over the weekend, Germany's snap elections. Down in Miami, President Trump set to deliver a keynote speech to global leaders at the Saudi-backed Future Investment Initiative Summit. Joining us now is Bloomberg's Tyler Kendall. Tyler, that's later on this afternoon. What's the address going to be about?
Well, John, we are expecting President Trump to focus on this idea of increased investment into the U.S. I actually spoke to one foreign policy official on the ground here at FII who said that this pledge by Saudi Arabia to increase investment in the U.S. actually goes against some of its own domestic policy goals to attract capital inside the kingdom instead of just exporting it outside. But the latter helps with relations with this new Trump administration. It is clear that there will try to be a focus on areas of agreement, whether that's investment in artificial intelligence, advanced manufacturing, being the host of potential landmark U.S.-Russia talks instead of areas of disagreement, like President Trump's plan when it comes to the future of Gaza or his complaints about oil prices. So it remains to be seen exactly which one of those paths President Trump will take when he does take the stage tonight at 5 p.m. Eastern. We did reach out to the White House to try to get some sort of preview, and they told us that we should just stay tuned.
Stay tuned. Tyler, thank you. They're always in production mode, aren't they? Tyler Kendall, thank you very much. Down in Miami. Coming up tomorrow, absolutely stacked show. We'll bring you some highlights from that address from the President of the United States, and we'll be catching up with the U.S. Treasury Secretary, Scott Bessent. We'll get some follow-up with Libby Cantrell of PIMCO. We'll hear from Mira Pandit of JP Morgan and Claudia Sam of New Century Advisors. A big interview coming up tomorrow morning.
Absolutely. There's a lot to discuss with Scott Bessent. Not only what's going on with the tenure that they're targeting, their northern light for this administration, but also he just got back from Kyiv, a war zone, and presented Zelensky with a mineral deal at a time when Trump is signed to sit down with Putin. Fascinating moment.
Join us tomorrow morning, 25 minutes with the Treasury Secretary, Scott Bessent, right here on Bloomberg Surveillance. From New York City, thank you for choosing Bloomberg TV.